Good afternoon, ladies and gentlemen. It is my honor to welcome you today to the UN Environment Program Finance Initiative Task Force for Climate-Related Financial Disclosures Pilot Group for Investors report launch. My name is Jessica Andrews, and I've had the opportunity to coordinate this group since November. The group was convened in 2018 by Remco Fischer, the UN Environment Finance Initiative Climate Lead, and Elodie Feller, the UN Environment Program Finance Initiative Investment Lead. You'll hear more from them throughout the day. It was driven by the efforts of 20 investors from 11 countries, and their invaluable contributions are what brought us here today. We are fortunate to have several distinguished speakers who will set the context for the day and provide us with their views, following which the report will be officially launched. Then Carbon Delta and Vivid Economics will take us through the details of the report, the landscapes, and context of TCFD for investors as of today. Following intermission, we will have a brief demo of a tool that was developed by the contributions of the investors who were members of this pilot group, and facilitated and led by Carbon Delta. And without much further ado, I'd like to invite, please, the three keynote opening speakers to the floor. It is my privilege to introduce Ms. Angela Darlington. She is the interim CEO of UK insurance Aviva, and she is a member of the Aviva leadership team. Prior to becoming the CEO of UK insurance, Angela was the Group Chief Risk Officer for Aviva PLC for 4 years and was a member of a number of Aviva's subsidiary boards. She was also the 2019 chair of the European Chief Risk Officer Forum. Angela is a well-respected role model for LGBT and women in leadership, featured on the Outstanding Leading LGBT and Executives list presented by the Financial Times. Angela sponsored Aviva's 2008 Climate-Related Financial Disclosure and is a member of the joint PRA, Prudential Regulatory Authority, Climate Financial Risk Forum. Angela, the floor is yours.
Thank you, and I'm glad that it's not only me that was thinking, crikey, there's some long words to cover in this session. As you say, I was, until only 2 weeks ago, Aviva's Group Chief Risk Officer, so it was in that role that I took on the sponsorship of our TCFD papers, which I think is a huge important area for risk management, and now I'm really happy that as a CEO I can take that into the broader business as we move forward. So I'd just like to start to say welcome to St Helens, and it is a pleasure to see everybody, so many people here today. I'm glad we fit in. I think at one stage I was a bit worried that we wouldn't quite fit in, which is always a good problem. And I wonder if any of you have saw the headlines this week. I think it was just yesterday on off the back of the Environment Agency's plan on flooding and coastal erosion in the UK. The headline said, "Climate change crisis flooding event may force UK towns to be abandoned." Now, even in a time of quite shocking headlines, that one really caught my eye. The idea that the Environment Agency was warning us that in some of the scenarios that they looked at, they may need to ultimately support individuals and communities in a move from an affected area. That means that in the UK, we are facing up to the prospect of moving entire communities from their homes. The idea of ghost towns which are literally left to sink below the waves. And that's no longer the preserve of some dystopian sci-fi Doctor Who type scenario. That's something that our Environment Agency are thinking about today. And I think that moves climate change from something which may happen to other people to something which will happen and to us. And I'm sure those of us who are in the room today are here because we are seized by the urgency of that situation, but not necessarily by it being the zeitgeist today. It takes a long time to put these reports together, and many of us have been working in this area for a number of years. But we do all understand the vital importance of changing course, as today's report is called, and that we really don't have much time. Now, Aviva cares about this for a whole number of reasons. There's the human cost, obviously, for our 33 million customers across the world, and for our 30,000 colleagues who range from Norwich to New Delhi. And on top of that, of course, as an insurer, we are absolutely in the firing line when it comes to dealing with the impacts of climate change. More frequent climate events, more severe climate events will affect all insurers. And as the recent Intergovernmental Panel Climate Change 1.5 report, that was the one I was worrying about, showed, we do need to take dramatic action now because there is no precedent for the scale of the change that's required to change the course on climate change. If you look at energy-intensive industries, they need to slash their CO2 emissions by up to 90% by 2050. Investments in low-carbon energy need to quintuple in the same time horizon. And that's just the flavour of the transition risks that climate change brings with it. But there are other kinds of risk too. There is litigation risk. Litigation risk for companies who fail to reduce their emissions, or who fail to disclose climate risks in a transparent way. And all of these risks, physical risks, transition risks, litigation risk, have the potential to affect the balance sheets of companies like mine. And we know that if the planet does not collectively address this risk, there is a systemic risk to the whole of the financial system. Now, there is some good news. The good news is that the potential impact of the money which is in the world's capital markets is enormous. But that money will only move to a world which generates a more sustainable path if, and I think this is a big if we can fix the system. We need more transparency, we need more information, and we need investment markets to have the right incentives to be able to take actions that help rather than harm the environment. And for me, today's report is a really important part of that journey. Now, as far as Aviva is concerned, we are committed to a transition to a low-carbon economy in line with the 2015 Paris Agreement. We have already invested 4.4 billion in green assets since 2015, and we've been at the forefront of sustainable finance since the 1990s. So this is not something that we come to just today. We were the first asset manager to formally integrate corporate responsibility into our voting policy, and we were founding signatories for the Principle for Responsible Investment and the Principles for Sustainable Insurance, all important starting blocks. More recently, we were asked to join the TCFD's, the FSB's TCFD panel. So we're really committed to this stuff, and we've committed to implementing the TCFD's requirements, and we've reported on them since 2016, and you can pick up your copy of our 2018 report in the foyer. I guess this year we try to include more information on how we have modelled our climate risk for the first time as part of our contribution to the wider knowledge on how to manage this risk. But really, that's only the start of the journey. We joined this investor pilot because we understand that as a preparer and a user of financial statements, these disclosures are really important, and we have to find a way for them to be more consistent, more comparable, and I believe the work that we have done shows that that can be done. And with that will come greater ability to model these risks and therefore to use those models in our decision making and to make a difference for society. Because our CEO, Maurice Tulloch, has said the cost of inaction is far greater than the cost of action. And I think these numbers that we've shown today show that. But it also shows that meeting the requirements of the Paris Agreement has to be a collective endeavour. we are not going to be able to save the world as we know it unless everyone works together. Maybe that would be industry, academia, regulators and legislators, international agencies. We all have a vital role to play, and absolutely delighted to see you all in the room today. Because we need a collective course correction if we are to keep our heads above the water on this matter. So I would just like to finish by saying welcome once again. I hope you all have an informative and productive afternoon and take away the imperative to make a difference in your role as you leave this room today. Thank you.
Thank you, Angela, for your welcome. Thanks to Aviva for hosting us. One thing I neglected to mention at the opening was that if there is a fire, you must exit through this door. We appreciate your remarks and a lot of good work being undertaken at Aviva. Thank you. We are very fortunate today to have two highly distinguished professionals to provide keynotes. The first is Ms. Sarah Breeden. Sarah is the Executive Director of the International Bank Supervision at the Prudential Regulatory Authority and has oversight of the Bank of England's work enhancing the financial system's resilience to climate change. She is co-chair of the Climate Finance Risk Forum, the objective of which is to build capacity and to share best practice across financial regulators and the industry in order to advance financial sector responses to the financial risks resulting from climate change. She is also the chair of the workstream of the Central Bank and Supervisors Network for Greening the Financial System that is looking into the size and of the financial and economic risks from climate change. Sarah, welcome.
Thank you very much, and thanks to Aviva for asking the Bank of England to come and talk to you today. My message today is simple. Climate change poses significant risks to the economy and to the financial system. And while those risks might seem abstract and far away, they are in fact very real and fast approaching. This is an unprecedented challenge. It requires urgent action, and it's therefore best addressed by us all working together. And the work that's being shared today is a great example of that type of collaboration. And I must say I'm really thrilled with the title, because I gave a speech a couple of weeks ago entitled Avoiding the Storm. So have a report come out saying how to change course is perfect. The financial risks that climate change poses are core to the Bank of England's mandates for safety and soundness and financial stability. But we've been clear that the financial risks that climate change creates are distinctive and require a different approach if they're to be managed effectively. First, these risks are far-reaching in breadth and scope. They'll affect all the agents in the economy, all sectors, all geographies. Their impact will likely be correlated and will be non-linear. All of that means they will occur on a much larger scale than other types of risks. Second, these risks are eminently foreseeable. I can't tell you now exactly what combination of physical and transition risks is going to happen and when, but I can say with a very high degree of certainty that some combination of these risks will materialize in the future. Now, uncertainty about what might happen cannot lead to inaction and inertia, but we do need to develop different ways of managing the risks. And then third, and for me, this has always been the most important part, the size of these future financial risks will be determined by the actions that we take today. The carbon we release today is creating the physical and transition risks of tomorrow, and the actions that we take over the next 5 years to bend the carbon curve or not will determine whether or not we achieve an orderly path to a low-carbon economy. Climate change, therefore, represents what my governor called the tragedy of the horizon. Once it becomes a clear and present danger, it may be too late to act. Now, that need to act obviously includes governments through climate policy, but since the financial risks that climate change creates are ours to manage in all future states of the world, it's incumbent upon financial firms, central banks and supervisors to act too. Now, how well placed are we to measure these far-reaching foreseeable financial risks that require action today? I'm sorry to say that many of the estimates that we have of these risks are not very good. The models are partial, they're heavily dependent on assumptions, and they don't capture well those non-linearities that are a key feature of climate analysis. But what is clear is that if limited or no action is taken to reduce carbon emissions, the impact on the global economy as well as the environment will be enormous. And of course, that's why governments have signed up to the Paris commitments. But the good news is that these risks can be managed. Let me be clear, the scale of transition is significant, but it need not create substantial costs across the economy as a whole. That requires, however, an early and an orderly transition. This need to transition is widespread. It doesn't just affect energy companies, it affects transportation, infrastructure, agriculture, real estate, to name just a few. And there will be winners and losers in that transition as stranded assets, whether unburnable carbon or unrentable real estate, turn out to be worth less than expected. A climate Minsky moment where asset prices adjust quickly with negative feedback loops to growth seems possible, and that's why we need to do what we can to ensure an orderly transition. Now, if those are the risks, what's the Bank of England doing about it? The action or lack of action of individual institutions will be critical in determining whether climate-related risks are well managed. And to that end, we became the first regulator in the world to publish supervisory expectations that set out how the banks and the insurance companies that we regulate need to develop an enhanced approach to managing these risks. Those expectations cover risk management, governance, scenario analysis, and disclosure, and they're designed to ensure that firms recognise the distinctive nature of this risk that I described earlier. So we expect firms to take a strategic approach, much as Angela described, led by the board with clear accountability. The approach has to be forward-looking, embedded in business as usual risk management, but grounded in the long-term financial interests of the firm, recognising, as I said before, that the decisions made today are creating the financial risks of the future. Over the next year or so, as tools and expertise develops, we'll embed more granular expectations into our policy to bring industry in line with our expectations. And that will draw on reports like the one issued today, and as well the work of the Climate Financial Risk Forum that I co-chair with the FCA and on which Angela is a representative, and that seeks to build capabilities, capacities and establish best practice in what is an immature field. Recognising that global challenges require global solutions, we're also collaborating internationally too. As Jessica mentioned, a coalition of the willing amongst central banks and supervisors has been established, the Natalie titled Network for Greening the Financial System, and we released our first comprehensive report entitled A Call to Action a few weeks ago. The bank has also been a very clear supporter of the TCFD, the standards that have been established there. The Disclosure is critical if the financial system is able to weigh risks and investments and direct its funds accordingly. Now, it's essential that this disclosure is forward-looking, speaking to future risks and opportunities and not just current emissions. Speaking personally, I cannot see that we can disinvest our way to a low-carbon economy. And so we need to look ahead to see how firms are adapting to the challenges that climate change poses. And we need to get to a position too where we have a better basis for consistent comparisons across different firms. Today's launch, therefore, is a really important step in providing practical guidance for firms to implement these recommendations. Now, to be able to judge whether we're sufficiently well prepared for the future and to see whether changing course is required, we need to look not only forwards, but we need to consider the position of the system as a whole. Now, we have a myriad of possible climate pathways with different physical and transition effects, and they need to be translated into economic outcomes and financial risks, looking ahead over many decades. Now, to simplify that challenge, we need to focus not on what will happen, but what might happen, and that's where scenario analysis comes in. Think of them as data-driven narratives that anchor our risk assessments and enable us to investigate a small number of different courses that we could follow in order to determine which delivers the best outcome. Scenario analysis should incentivize each financial firm to play its part in the transition, and by taking different decisions today, participants in the financial system are able to minimize their future financial risks. But we need also to think about this risk at the level of the system too, to judge whether the actions of individual institutions in aggregate are delivering the smooth climate pathway that individual plans will assume. And to that end, the Bank of England will consider including climate-related risk factors in a future biennial exploratory scenario test of the UK financial system. The PRA is also asking UK insurers, as part of its market-wide insurance stress test this year, to consider how their businesses would be affected in different physical and transition risk scenarios. And the NGFS plans to set out voluntary guidelines for how central banks can use scenario analysis to assess system-wide financial risks. This scenario analysis then bridges the gap from our top-down and bottom-up understanding of risks. That will support different actions by financial firms, by central banks and supervisors, and ensures that the actions we take today will ensure that everyone is changing course to deliver that early and orderly transition. Now, to do this, we need early action, a sustained effort, and a recognition that it's better to be roughly right now, not precisely right when it's too late. We need to work together internationally and domestically, public and private sector, to achieve a smooth and orderly transition. But remember, that window for an orderly transition is finite and it's closing. Our work, the work of the report today to seize that opportunity, could not be more important. It's not an overstatement to say that the future of the planet depends on it. Thank you.
Thank you, Sarah, for that very important message. I now have the opportunity to welcome Dr. Christopher Hope, Professor Emeritus and Climate Policy Researcher, Page Model Developer at Cambridge Judge Business School, and visiting professor at University College London. In a 30-year career researching climate change, he has published extensively in books and peer-reviewed journals, such as Nature and Climate Change. His PAGE model has been used by the Stern Review on the economics of climate change and by the U.S. Environmental Protection Agency to calculate the impacts of climate change and the price that should be placed on carbon dioxide emissions. Today, he will explain to us the latest research of the PAGE model. The PAGE ICE model tells us about the global impacts and risks of climate change.
Thank you, Jess. Take care. So, I suspect you, like the rest of us, have noticed a new urgency in the discussions about climate change in the last few weeks. Indeed, some people are calling it a climate emergency. We've seen a deep-seated emotional response to changes that are happening in the real world. But to respond to climate change effectively, we need to work out what impacts, costs and risks are actually driving this emotional response. And the best way to do this is to use an integrated assessment model to bring together the best scientific and best economic information, even though, as Sarah said, a lot of it is still incredibly uncertain. And as Jess said in her introduction, I've been responsible for developing and using the PAGE integrated assessment model, most recently alongside a team led by my colleague Dmitry Yumashev from Lancaster University. And very briefly, the latest version of this model, called PAGE ICE, looks at how emissions of all the greenhouse gases, not just carbon dioxide, will change the climate. And we've worked very closely with researchers who've built complex physical models so that we can do what Sarah would want us to do, include nonlinear feedbacks and tipping elements into the model, most notably to do with the thawing of permafrost from the changes that are occurring in the Arctic. And the model includes 4 types of impacts. It divides the world up into 8 regions and runs out many decades, in fact out to the year 2300, because that's what the scientists tell us we need to go out to capture the full effects. And typically it runs 100,000 times in order to build up a full risk profile of the impacts and costs of climate change. Well, now, today I've only got time to show you a couple of the most relevant aggregate results which come from this kind of modelling. But if you want to know more details of the model, please do ask me later. I'll be around until the coffee break. So where is climate change headed? If countries stick just to their present commitments, which are outlined in the nationally determined contributions from the Paris Agreement, then the global emissions over time and the global mean temperature rise by 2100 look like this. And the top panel shows that our emissions globally would fall by a bit over 30% by 2100. And the bottom panel shows that if that's the path we carry along, the global mean temperature rise is along the bottom there in degrees centigrade, and the chance of reaching that temperature is shown vertically in the graph. Technically, it's a probability density function. And you can see that the global mean temperature would have about a 50% chance of rising by more than about 3.4 degrees by 2100. And it would still be rising for decades or centuries after that if we continue down that path. So what would the impacts from such a climate change be? Well, this slide combines together at the very top level the impacts in all the 4 sectors, in all the 8 regions of the world, over the whole time period out to 2300, and it shows it as a net present value discounted back to today. And the mean value, as you can see I've highlighted there, of the impacts from climate change is about 1,400 trillion US dollars. Trillion with a T, not billion with a B. And look at the long tail. It goes right out to several thousand trillion US dollars of a possibility, because those are what the impacts would be if, say, the ice sheets in Greenland and elsewhere were to melt, and we will get multi-meter sea level rises, maybe 8 meters or more by 2300. And these are very recent results. They've come from 4 years' work with the best climate scientists and economists led by Dmitry. And, you know, if you see those kind of numbers in there, you can see why people are anxious. I'm anxious too. But to react effectively, we need to go beyond that anxiety. And what we need to do is find a way of internalising these kinds of impacts into business decisions. And the foundation for that should be a comprehensive, strong, fiscally neutral climate change tax which rises over time. And the polluter pays principle says that we should set that tax at the mean impact that's caused by 1 more tonne of carbon dioxide, and that goes by the name of the social cost of carbon dioxide. In Angela's terms, that's what we need to do if we're going to fix the system. Now, Page Ice can calculate that. It can calculate the social cost of carbon dioxide. Like the impacts, it has a long right tail. The mean value, which is the one we should initially use, is about $310 per tonne of carbon dioxide. And it rises at about 2.5% a year as we get closer and closer to the time when the most serious impacts are likely to occur. Well, what does that mean? To actually levy the tax, you don't need to measure people's carbon dioxide emissions. All you do is charge the tax on the fossil fuels when they enter the financial system. And that will carry through into the prices of those fuels and then the prices of goods and services that are produced using those fuels. And this chart, I'm not going to read it because I don't have enough time. It shows roughly how the prices of fuels and flights would change if we had this kind of climate change tax. And of course, fuels that don't affect the climate would not be subject to the climate change tax. Now we know the businesses and consumers and other organisations, including investors, will be able to calculate the risks and opportunities that climate change would bring. And there will be huge opportunities. So the climate change tax, if it's put in place in this kind of way, would raise in the UK about £100 billion of tax revenue for at least the next decade and probably for longer than that, because as we say, the tax goes up a bit each year in real terms, and as we bring down our emissions, the total revenue would stay roughly constant, at least for a decade or more. Now, if you're like most people who are listening to this, you're thinking, gosh, do we really want to make fuels more expensive and flying more expensive? Aren't household budgets under great stress at the moment? And the answer is yes, they are. But the answer is yes, we do want to do that. But to get public acceptance and keep public acceptance for it, the revenues from the kind of tax that I'm talking about must be returned directly to people, either by equivalent cuts in other taxes or by other methods. And what I've shown on this slide is one way of returning those tax revenues to the public directly. And of course people would like to have income tax basic rate at 10% rather than 20%, and basic rate of VAT at 12% rather than 20%, and so forth. And this is the way that we get public acceptance for this kind of measure, which is what we need to do if we're going to tackle the issue of climate change. There's an alternative way of returning it. We could use the fee and dividend system that's been proposed by James Hansen in the US and basically just give a handout every month to every household in the country. If we were to do it that way, the handout would be about £500 every month to every household in the country. It would be an enormously redistributive way of giving back the income. But the point is we can decide how to do that. The income is coming in as a tax revenue and we, as a country, can decide how we want to return it. But my view is to get public acceptance, we do need to return the vast majority of it directly. Well, a climate change tax like this would take us a huge way towards one of the other scenarios that we would hope we might move towards, which would be cutting emissions to net zero globally by 2075. And if we were to do that and move down this scenario, then the calculations show that we would have about a 50% chance of keeping the temperature rise below about 2 degrees centigrade in 2100. And the temperature would have peaked at that point and would be coming down after that. But the costs of doing that, of course, are not negligible. I mean, you have to think that there is a great transformation required. They're also uncertain, in the same way that the impacts are uncertain. And we can calculate those with the model, and it looks as though the net present value of the abatement costs for getting to this kind of scenario, which keeps us below 2 degrees with a 50% chance, would be, mean terms, about $180 trillion over that time period. This is a huge opportunity for many companies and organizations to be part of that transformation. And if we were to do it, then the impacts that we're left with from climate change would be, instead of $1,400 trillion as a mean value, about $465 trillion. And you can see I've highlighted in green, because it's really good news, that the mean drop in impacts is over 5 times the mean abatement costs. It's cutting back emissions in this way is well worth doing. It may be worth going even further to a 50% chance of staying below 1.5 degrees by 2100 rather than 2 degrees, and Page Ice and integrated assessment models like it can analyse that kind of scenario too. So this is the point at which I say, well, over to you, because I'm really excited to hear about how you can complement this highly aggregated analysis with the very crucial detailed bottom-up work that you need to do and that your partners have been doing about what this means at the company and organisation level. And I would hope that you might, at some point, want to talk to me about how you could also play your part in supporting the continued improvement in the calculation of the numbers that I've just shown to you. Because, as Sarah said, they're always partial, they're always evolving, we can always do more work to make them better. But we want to continue improving those kind of calculations, that our decisions can continue to be based not just on emotions, although those are important, but also on sound science and economics. Thank you.
Thank you, Chris. Some really very interesting results. If I could ask everyone to join me in thanking our very distinguished guests for their interventions this morning, we will now move to the next session. Thank you. Our next presenter and speaker will be known to many of you. For 10 years, Remco Fischer has led climate change efforts on behalf of the UN Environment Program Finance Initiative. He has shepherded countless climate-related initiatives for UNEP FI, working closely with leaders across investment banking and insurance industries. I would now like to invite Remco Fischer to the floor to provide UN Environment Program's perspectives on climate change and to officially launch the report today.
Thank you very much, Jessica. And I'm going to be doing this launch now together with our partners in this process, Carbon Delta, David, and Jason Ice from Vivid. You can already join me here because you're part of the same block, so we can do this all in one go. But thank you also to all of you for being with us here today. We're going to now enter the segment in the agenda where we're going to be speaking about, Chris, what you were asking us to present and to do, which is to complement the big picture science with some bottom-up work and conclusions that we've been doing with the investors. Before we do that, I would like, of course, to give you a few perspectives as to why you see the UNEP, the UN Environment logo up there. Where are we coming from onto this agenda? Why are we here talking to the investment community in the UK? Why is this topic important to us, and where does it sit? 10 days ago at the Mauna Loa Observatory in Hawaii, it was measured that Earth's atmosphere now has a CO2 density of 415 parts per million. It was only 6 years ago, in 2013, that the more emblematic threshold of 400 ppm was crossed for the first time in human history. So we're not making progress. Today's amount of CO2, this 450 ppm, is 30% higher than when measurements began in the 1950s. It's double the amount, the ppm, that we had before the Industrial Revolution in the 18th century. And it's now highest than it's been in the last 800,000, at least the last 800,000 years, if not the last 3 million years. It's not scientifically proven. It's also hands down intuitive that such a radical change in the chemical composition of the atmosphere over such a short period of time is not going to remain without its planetary serious consequence. And that consequence is that today's world is 1 degree warmer, undoubtedly, than the world we had 200 years ago. And that's not only a statistic. That 1 degree is changing the face of the planet and the lives of people in disturbing ways already now and at a mind-blowing pace. A couple of examples. The 4-year period between 2015 and 18 has been confirmed as the hottest on record. Average global sea level has risen 8 inches in the last 100 years. 11 of the strongest 30 Category 5 hurricanes on record have occurred in the past 15 years. The list goes on. In terms of social, political, and economic impacts, climate change is being consistently characterized by security experts as a threat multiplier, capable of destabilizing entire societies and tipping the emerging middle class that we have seen emerge in emerging markets of the last decades back into poverty. There is, for instance, credible research linking the dire economic outlook in places like Damascus with an exodus of people from rural Syria into urban Syria as a result of drought levels that had not been seen before in that region, at least not in a long time. All of this is the result of 1 degree. So do we really want to end up with 4 degrees? Or as Chris, you pointed out, if we implement all the NDCs, it might be somewhere in between 2 and 4. But if we do not implement the NDCs, we might end up with 4 in all likelihood. 4 times of that what we have now, or even more, because the risks and the impacts are non-linear. Very often, to people in financial markets or in the private sector, 4 degrees doesn't sound like much. But there's one interesting statistic here that I've been using lately, which is the difference in the mean global temperature between now and the last ice age was 6 degrees centigrade. So we are, and the last ice age unfolded over many centuries, if not millennia. I'm not sure about that, don't quote me, but over a much longer period of time than the couple of decades over which we are now moving towards 4 degrees. Kind of an inverse ice age, if you wish. I don't think anyone with the capacity and honesty to think this whole thing through would ever come to the conclusion that we're on the safe path. And I don't think there's hyperbole, nor any drama, nor alarmism whatsoever when people like David Attenborough and Greta Thunberg and the new grassroots movements that we see here also in the US, backed by all the science in the world, look plainly at the facts and conclude that 4 degrees may, by the end of the century, be too much for our global civilization to bear. So the key question that from our perspective as the UN brings us together here today is, why are markets failing us on this? Why do markets seem to be usually so efficient in internalizing into asset valuation, into risk pricing, information forecasts, even the slightest movement in market intelligence? But when it comes to a pretty much well-forecasted potential end of civilization by the end of the century, they still react with, in aggregate, not the people that work with us at UNEP FI, but in aggregate financial markets, with a collective shrug off. A good part of that, not all of it, but a good part of it, is what Sarah, you pointed out earlier, is the tragedy of Horizon, coined by Governor Mark Carney so accurately in 2015. The problem that our political and financial systems, as well as many of our technocratic institutions, are configured to be intrinsically short-term, while climate change and other problems, such as the loss of biodiversity and species that was just talked about quite prominently over the last couple of days and weeks, those processes are tectonic in nature, span decades, if not centuries, in a rather creeping yet no less destructive way. The governor, when he was speaking about the tragedy of Horizon, said that it was not the role of financial regulators to facilitate and drive the low-carbon economic transition. That was for other parts of government to do, other regulators, the regulators of the real economy. But he also said that it was the role of financial regulators to ensure the financial system remains resilient in light of the many uncertainties that we have, but also in the light of the many certainties. Because we have many certainties, even if we also have many uncertainties. And to ensure that markets have the right information over the appropriate timeframes, and that is critical, and that the underlying disclosures are consistent, comparable, reliable, and clear. The recommendations of the FSB TCFD, I'm going to use the acronym only this time around, published in 2017, lay out a new global framework for the disclosure of climate-related risks and opportunities, and are, as such, a direct response to that tragedy of Horizon. The need for climate-related transparency is not new. We've been working on this over the last 2 decades. Especially here in the UK, we've seen pioneering efforts on that front by organizations like the CDP. And we've seen pioneering regulatory efforts, say in France, through their inclusion of that into their Article 173 in the Energy Transition Law. The TCFD, though, opens a new chapter. Its key contribution is that it politically elevates the climate challenge to where it needs to be, and where it has not been in a long time, which is the consciousness of people like Angela, the CEOs, the CIOs, the CROs of leading financial firms onto the boardroom table. In more mundane, more technical terms, climate disclosure practice up until the TCFD featured 2 fundamental flaws. First, it was static at best and backward-looking at worst. And second, it was by and large not really done by the financial community. There was this notion of it's the companies in the real economy disclose, we investors, financial institutions, we read disclosures and integrate disclosures. The problem with disclosures being static is that the climate isn't. And that's why disclosures from organizations based on today's carbon price or based on today's extreme weather probability are not particularly insightful. And that's why climate disclosures pre-TCFD, by design, fell short of addressing Mark Carney's tragedy of Horizon. The TCFD also achieves to turn investors and financial institutions from only consumers of information into issuers themselves. That makes sense. Climate risk becomes a threat to financial stability when it accumulates to a dangerous level, and that happens chiefly on the portfolios and on the books of financial institutions, and therefore it makes absolute sense that disclosures also happen at that level. At UNEP FI, we're big fans of the TCFD, you can tell. It's difficult to like, it's easy to like it, it's easy to endorse it, it's difficult to implement it and adopt it. Carrying out forward-looking climate risk and opportunity assessments in a scenario-based way across asset classes, regions, geographies, both for the physical impacts of climate change as well as the transitional impacts of climate change is, I mean, speaking that out already is difficult. I mean, doing it is like, doing it is far from trivial. So at UNEP FI, we decided to work on that with our members and to create coalitions of the willing, like yourselves in the regulatory community, this time of market actors. And we created 3 pilot groups, insurance, banks, investors, to tackle this TCFD implementation, to tackle this TCFD implementation challenge. 16 banks started, and we published the on-loan books, and we published the methodologies last year. But 20 investors from 11 countries, well, I think I should be looking at my slides. These are the UNEP FI members with whom we've been working across financial industries on TCFD implementation. Let me stay there for a minute. 20 investors from 11 countries did not wait long following the banks. And over the last year, they've been working collaboratively. They've been convened by us at UNEP FI, but aided by David and his team at Carbon Delta and Jason and his team at Vivid in exploring methodologies modeling, in enhancing and fine-tuning some of the existing methodologies, and importantly, applying those methodologies on key segments of their portfolios. And all of this work and all of this experience has been put together in a report. And the report that we're launching today. Changing course. And so it's my pleasure to be launching this report now. Boom, it's already happened. We've launched it. And you haven't even noticed. But you will in a minute, because it's been delivered to all of you to your virtual doorstep in an email that you should have received or will be receiving in the next couple of minutes. And the people following this through webcast, we're webcasting this in the internet, they will be receiving the report to their emails too. If you haven't, please don't tell. I think there might be some that do not, but most will. Before you start reading it though, please stay focused. Because I want to tell you real quick, and then I'll pass over to our partners what this report actually does. It does a number of things. Firstly, it provides a mapping of all the methodologies and modeling approaches that currently exist and that are waiting to be used by investors as investors try to carry out forward-looking risk and opportunity assessments. And so it does give you the mapping, the state of the art. And Jason will be telling you a little bit more about that in a minute. Secondly, it details step by step the one methodology in particular that the investors used in their piloting, the 20 investors, which is a somewhat expanded and enhanced version of the carbon delta approach, and David will be taking you through that also. It provides a total of 17 case studies developed and submitted by investors in the group, and through that case studies, investors make available their experiences, their lessons learned, what they liked about this, the challenges faced, key weaknesses and gaps for future action. And interestingly, the other thing that it does, it starts applying this methodology and the data behind it onto different universes of companies and seeing what happens if you do that. And there's some quite interesting insights that have emerged from that analysis. For instance, if governments delay decarbonization action, the numbers tell us that the costs of that, compared to a situation where governments would carry action now, as they should, and steadily, the corporate costs of that delay in action for a universe of 30,000 companies over the next 15 years is $1.2 trillion US. This is one of the key figures, and I think it's the figure that has been picked up by the press quite a bit, and a figure that we can discuss a little bit more. There's obviously other figures that are in the report. And so I think there you have it. The launch is done. I'll stop here. Thank you very much. And it's my pleasure now also to ask you, David, Jason, you first, to take us through this pretty universal and very, very useful mapping of existing methodologies that you have carried out. Thank you.
See if this is working. Excellent. Those are yours? There we go. That's me. Well, thank you, everyone, and good afternoon. And thank you for the perfect tee-up, I think, in the previous presentations for now the description of what it is we did and why it's so important, and also what the challenges of it have been. So I'll take you through essentially the work we did to review and look at more detail what types of methods are out there and what some of the leading investors are doing to understand the nature of this very imminent, very scary, and also very important set of changes. So I wanted to start off with, although I think there's been a lot of this context setting done already, but I think it's important to remember why scenario analysis in the first place. What drove the TCFD to make this recommendation, and why is it at the heart of this pilot and at the heart of what I think leading investors are doing today. And at the base of it, and as I think the previous speakers really underlined, is the fact that we're talking about a challenge which is deep but very uncertain, both in its timing, its magnitude, and its nature across the economy and the natural systems. It's one that's going to require and induce, I think, a large amount of dynamic change in the economy in terms of business models, strategies, and resulting complexity of how that impacts financial performance. So it's a world that requires you to think about it with nuance and with a depth of understanding and a range of understanding. And what better tool to start doing that and thinking about that than scenarios that allow you to understand how different views of the world, how different assumptions might drive ultimately decision making. And from the point of view of what the TCFD has tried to drive across the sort of the four scopes, I think governance, strategy, risk management, metrics, and targets, I believe that the scenario analysis is truly at the heart and the base of all of that, right? It's what helps you understand strategically those impacts and how they relate to your business. And that in itself is what enables responsible governance, well-informed governance. So governance without that would be hollow. And at the same time, it's what enables robust and accurate risk management. Without that kind of understanding, how are you going to manage those risks? And finally, it's what enables meaningful and impactful metrics with a true impact on the kind of risk and returns that financial institutions need to deal with. So scenario analysis isn't just part of what needs to get done. It's truly at the heart of it. So what did we do? Oh, that's this one. Sorry. So what did we do? We looked at a large number of scenario analysis methodologies and the providers providing them. And the good news is that there's a really diverse and continually improving space. We reviewed them. We had to limit our scope to be quote unquote fair. So we limited it to publicly published examples of scenario analysis for investors. But even that relatively limited scope produced a real vibrant set of approaches being developed out there. It included, I think I counted correctly, 14 different providers. And as I said, that list isn't necessarily exhaustive. Many of those providers share common methodological elements, and I'll talk through that and what it means, drawing on similar data sets and modeling components. But there's quite a lot of nuance and variation, which I think is important in such a complex space. So as a result, I think if you're an investor, I think you can have some confidence that you've got the tools to draw upon. And having seen the evolution of this space myself for many years, and well over a decade, from the time I think when much of this risk analysis or this scenario analysis was done by policymakers, through to when it started to get done by the most exposed sectors in the economy, power, oil and gas, industry, even agriculture, to it being adopted and disseminated, I think, perhaps primarily through public financial institutions and now private financial institutions. The extent of progress is incredible. As we heard earlier from Chris, there's a mountain of accumulated knowledge that's been developed over many decades thanks to good academic and research institutes. There's a huge foundation of analysis. And I think what we've seen and what's reflected in the vibrancy of the market to help support scenario analysis is that has been very rapidly and is being very rapidly repurposed to help bridge the gap between those perspectives created over many years and what's required for financial actors. But let's not underestimate that last step, which I'll talk about in a second, because there's a lot to do to make these assessments really relevant and speak to what financial sector actors need to know and what they need to know to really manage the risks and the kind of the core risk return lens that they generally look at. So our kind of unenviable job was to try to make it simple. It will appear somewhat simple, but we'll have to constantly tell you that it's not. What we've done to help map out and think through the space is create a broad framework of elements. And it's a bit of a snake diagram, so you have to kind of weave your way through, starting with scenarios. Actually, what's likely? What do we think the world is going to look like? What do we believe is going to happen? Do we believe? And if you're a financial institution, what do you think the likelihood is of the different trajectories we heard about earlier? Are we on a pathway, or is there even a possibility, be it small, of being on a 4-degree or 4-degree plus world? Or do you have, or what do you believe or assess by way of the likelihood of Paris and that process getting us to perhaps a well below 2-degree world? What are the scenarios you think are in the world to come, and how do you deal with them? It's an incredibly important part of the analysis. After that, then you have to think about how those translate into what we call physical hazards and transition hazards, or shocks, you might say. So what is the actual physical mechanism for the physical risk side? What's the natural changes that we're likely to see? And on the transition side, what are the more techno-economic, policy-like changes, the timing, the response to those shocks? So to continue to conduct the analysis robustly, you have to think through both where we're going and what that means in terms of the hazards and shocks that the economy faces. And then you get into the real core of what we call the impact assessment methodology. And this is a plethora of modeling techniques spanning from macroeconomic models into energy and land use system models, as well as global climate models and the derivations from those into hazard models. And it's a broad space, and one that frankly we didn't attempt to summarize in one slide. But what we did do is say, well, we can assess those based on two primary dimensions: the scope of impacts they look at, and the depth of exposure from an asset owner sort of point of view, in terms of how deeply it affects or how deeply it looks at the effect on the value of assets. And so at the heart of it, what we've done is we've tried to break down to give a sense of, given what you need to understand about these things, how well do we match against it? And then the final lens, which sits alongside all of this, is around the resolution of analysis. And of course, different investors will look at different levels of resolution for different purposes. In some cases, the main interest might be at a macroeconomic level, whether it be regional, global, or divided into more sector-level analysis. At other levels, it's quite important to understand firm and sometimes even facility or underlying asset values. And across the areas of use for investors, from what might be very overarching strategic asset allocation through to things like security selection, the level of resolution makes a big difference in terms of what that toolkit offers and how it informs decisions. So those are the main elements that give us a sense of have we covered what investors will require. I should ask one thing. There's one more box I didn't talk about. It does, I think, also, and it's important to underline, it does involve a balance between quantitative and qualitative approaches. I think what we've learned and what we'll talk about a little bit more as we go through it is that while sometimes it's tempting always to quantify everything, I think as most of you know, probably all of you know, there are some things that it's often better to have a more accurate qualitative understanding of what's going to happen than a very clearly inaccurate quantitative assessment of it. And so one of the things I think it's important to think about, and what we've tried to map out, is what is the balance between quantitative and qualitative, and how do they work together. So that's the overall mapping we did. Just to give you a little bit of a sense, I won't go into too much detail. You can read the report. I keep doing that. It's important to think about the interface, as I said, between scope and depth. And what we mean by that, and I do want to explain it a little bit, on the left-hand column, scope really involves those levels, as I said, from macroeconomic impacts through to micro and the full chain of microeconomic impacts. It includes the direct impacts, let's say, on a specific asset. This is transition risk. I have another one for physical risk. But the direct impacts, perhaps, say, of a carbon price on the price of fuel for a utility. But it might also impact the markets into which that utility or that firm sells its goods, and it might also impact the supply chains that it has. So there's a full value chain that needs to be understood if you're going to understand what happens to financial assets. And across that, there's large macroeconomic effects, including how those might be regionally focused and how this might spill over across the economy. And at the same time, there's differing depths of understanding that risk. So what we often find is the first step, and what people might be familiar with, is looking purely at exposure. And that's much more qualitative. Is this simply an asset or a company that's exposed to these risks? Does it have high carbon intensity, for example, for people who've known the history of some of the reporting on this? The next level then is to understand what's its actual sensitivity to it. So what does it mean, not just in terms of, say, carbon intensity, but in terms of the financial shock, let's say, or impact it might have. So in the case of something like climate risk, it's about understanding what those costs involved with that intensity are and how much that firm or asset must bear them itself. And then finally, and most importantly, and where we'll see probably the biggest gaps to date, is what does the firm do when that happens to it? It's one thing to say that you'll be hit by a cost shock, but as we know, firms don't just sit around and do nothing when faced with a challenge. They often adapt and adopt, and we've seen it already in motion across almost every sector, even the oil and gas sector, but even more interestingly, things like the automotive sector, even things like the real estate sector. These things get adapted to. So in understanding the analysis, I want to emphasize there's a broad set of interfaces in terms of the types of impacts and the depth and sophistication with which you can gauge those impacts. And as you can imagine, it's a challenge. So I'm going to give you 2 slides which you should look at in more detail in the report itself, and I won't talk through them too much, but 2 slides then that give you a flavor of where we are in terms of the mapping. So I'm going to skip through that one. It's a bit hard to see, but we've got 2 of these maps. I'm going to quickly flick back and forth so people can get a sense for transition risks and for physical risks. And so on the left-hand side, you've got the providers, which across the 2 add up to about 14. And then on the top, you've got a sense of what would be necessary, what do we gauge as a financial institution needing to really understand and start to manage these risks effectively. And I think I want to leave you with 2 big impressions and then ask you to read the report in more detail. First is just to reinforce the message that there's quite a vibrant set of methods out there, and that coverage, although not necessarily always in one tool comprehensive, coverage now is giving us quite a broad set of these risks. It's expanded tremendously over the last couple of years. I think there's been a lot of learning between some of the names that you see on this slide and you'll see in the report, and some of the underlying academic institutes running the type of models like Page ICE, for example. There's been a lot of learning, there's been leveraging it, and there's been a very impressive, probably unexpectedly impressive degree of building out the ability to look at all of these risks in a relatively comprehensive way. I also want to, again, emphasize that this is an indicative and partial picture, and that it may already be out of date. I mean, honestly, it's so fast. The report was launched today, but of course it was finished about a month ago before it went into design, and things happen so fast that in 4 weeks you will already see providers improving and expanding upon their methods, and we'll hear a little bit about that experience within and through the pilot itself, which is a good example of how fast the market reacts. The other thing, as I let you sort of look at the other slide on this, the physical risk impacts, which shows a broadly similar conclusion. The other thing I want to say is that although much of what the report talks about are the direct providers looking at the financial risk element, I would want to also reinforce and emphasize, and I think Chris's presentation did a really good job of this, that there is a really rich set of research actors, universities, research institutes, pushing the leading edge on these methods, and as a result, there's a really strong research base that's gradually pushing itself up and through. So broadly, an extremely dynamic space, not yet perfect, and I'll talk about some of the gaps explicitly as my kind of part of my concluding remarks, but one which I think we found has been moving impressively. So now let me get to the more negative parts of my of the review. There remain gaps. There remain large gaps. As usual, we can call them areas for emerging advances and opportunities, but there still are gaps, and there's things that I think will remain challenging and are challenging, for example, for those who joined into the pilot exercise. First of all, there's gaps in the scope of the methodologies. Currently, methodologies don't generally cover the entire value chain. They don't necessarily do it in a holistic, completely joined up way, from the supply through to the direct impacts and all the way on to markets. It's challenging, and we don't yet have it. Currently, methodologies don't extend across all of the range of asset classes with a consistent level of bottom-up detail. And methodologies don't incorporate risks that might be somewhat more challenging to gauge, like legal or reputational risks, which are certainly not imaginary. They're very real, in some cases the most relevant to asset values. At the same time, we have gaps in some of the depth of the methodology. The most striking one is what I emphasized earlier. We don't know much about how firms will adapt. There's recent experience on some of these shocks, and we know what reactions have been, but it's very hard to gauge the capacity of firms to adapt, whether it's to transition risk or whether it's to the physical impacts. And in the case of physical risks in particular, we still don't know much about the opportunities that go along with some of these things. Obviously, there's a lot of talk about green tech. We know the EV story, but what happens in a world where there's a need for adaptation, and are there aspects that the financial industry needs to know about in terms of opportunities as well as risks? Finally, in terms of integration, we remain with going to the complexity of the phenomenon. integration remains a work in progress. How do you take, first of all, climate transition risk and physical risk, which are two entirely different phenomena, although they are interrelated, entirely different phenomena, and make them provide you with a common set of metrics and comparable risks and returns? We're not there yet, but everyone's working very hard. How do we think about the top down and the bottom up? When you think about a macro perspective and you think about a plant or an extraction well or a coastal real estate, how do you make sure and try to match levels of resolution that are quite different? So we're still at that challenge. Finally, what I want to say is that underlying a lot of those challenges, and something that's come out a lot across the pod, is that there's a need for better disclosure, not just by financial institutions, but by those investee companies. If you think about it, it will be very hard to understand private equity or infrastructure if those assets classes and asset owners aren't reporting on what those assets already are. So the data gap and the information gap remains large and underlines a lot of these challenges. My very last slide. I do want to just say, reflecting back on the experience, caveat emptor. These methodologies, as I hope I've conveyed, are multiple and complicated. They have a lot of underlying uncertainties. This is not a box-ticking exercise. This is not something you're going to just take and run something quickly and say, okay, now we understand it. This doesn't work that way. The leading institutions, amongst which are our hosts, Aviva, who've worked on this for many years, show that what you need to do is create multidisciplinary teams that understand the breadths of risks in depth in their organizations. You need to create deep integration into the core risk management, strategic asset allocation, security selection processes. And you need to think of this as something that's far deeper and an integral part of your risk-return lens. Thankfully, financial institutions are full of smart people who are driven and who are at least supposed to be the experts in identifying risks and opportunities in an uncertain world. So I have all the best expectations that they're going to provide an incredible response to the challenge once they get moving. And I do want to say and thank the participants in the pilot who, as you read it, will find that they were extremely open about the learning and experimentation they undertook in this, and they were refreshingly honest about both the insights they got out of it and the challenges they faced. A very interesting read. I encourage you to do so. And now I guess do I hand over? Okay, great. Well, I would love then to hand over to some more of the detailed content to David from Carbon Delta.
Hello, everyone. Yes, my name is David from Carbon Delta. And, well, I'm just going to start off by saying I'm going to move very quickly because we're, I think, a little bit pressed with time. But I just wanted to say thank you so much to the UNEP FI Secretariat as well as the investor group for choosing us. This was a really very important and, well, very fruitful experience for us. And I can imagine that when you're deciding amongst a group of consultants or interested participants in a project, that you can choose between so many different kinds of research and options out there. And I think you took a little bit of a risk by choosing a small and slightly innovative company in Carbon Delta, and we really appreciate it. It's been a great experience, so thanks a lot. We hope you're satisfied, and we hope this is just the beginning of a longer relationship where we can exchange views and improve and build upon the work that we already started. I also want to say that I'm by no means responsible for the implementation of the project. It's mostly done by my colleagues, and many of those have joined me today. We're a small team of about 30 people, but we have more than half of the company that has come to celebrate today. And we'll do so tonight without the interruption from those Arsenal fans, like we experienced last night. Yeah, I just wanted to say any of those that might know me or a couple of the people in Carbon Delta, please, please stop by and say hello to the others that have made this happen, because they'd be glad to meet you. I just wanted to say, again, I'm going to move quickly. Effectively, the idea of Carbon Delta is maybe somewhat simple. It's to try and monetize the impacts that climate change makes on the value of a company. And you can see here, these are just examples. They just say that, well, physical changes from climate cost money. That impacts the value of a company. So do transition risks and transition opportunities. Companies win and lose throughout this whole climate change experience. We try to monetize that down to a security level. And that is done through let's say, the use of big data and a lot of data sources that we have come to build into a model and software system. That software system utilizes bottom-up data on assets, on where companies are located, but also top-down data with regards to how the climate is changing in particular locations around the world and what climate change policies are being passed in different sectors and countries, and so on and so forth. So there's a lot of data sources that we use. We try to be transparent about it. And the modeling process roughly goes as follows. We do impact modeling. We come up with a time series of cost. That time series lasts up until the end of the century, depending on the exact scenario. We discount the cost. The discounting is done with company-specific data rather than probably societal specific data. And we compare the cost with the market value of the market capitalization of the company. And that gives us a percentage of the company's cost that is at risk from a particular scenario. That's what we call the climate value at risk. You've also seen, of course, Aviva talking about climate value at risk for a number of years now. And I think let's say it's kind of caught on. I would commend probably Aviva as one of the first organizations to really start to use that term. What we did in the pilot project was focused around 4 pillars. As you see here, methodologies, financial modeling, real estate, and developing an online tool. What I'm going to talk about is really the methodologies. We could talk a lot about all 4 of them, but that we don't have enough time for that. So Anya, my colleague, will present the online tool in around an hour. So what we had before we started this project roughly looked like this. We had a few methodologies that were focused around temperature-related risks for policies. We also had technology opportunities which aligned with the policy risk. And then we had one physical risk scenario. But in that physical risk scenario, of course, there's a lot of different kinds of physical hazards embedded. And that came together to deliver a climate value at risk and a temperature level, the temperature alignment of a particular company. And we expanded this considerably through the collaboration with the group. We developed 6 additional 2-degree scenarios under the policy and technology pillars. And we also developed another, let's say, worst-case physical scenario, which also pertained to all the different physical hazards that we model. And I'm going to just show you a little bit about each of these 3, what we had in the beginning and what we had at the end. And in that, I'm going to start off with the transition risks, which are related to climate policies. Again, I'm going to go a little bit fast, and I'm sorry for that, but I think I'm under a little bit of pressure. So first, we take policies at a country level, break it down to a sector, and break those sector targets down to each facility that operates in a sector. It's very traditional how this is set up, which is often how climate policy is implemented at country level. Usually, someone in the Ministry of Environment sits down with sectors at risk, negotiates what the target's going to be and which facilities are going to take different levels of targets. So this gives us effectively emission reduction requirements over time, and that's what we also use to forecast that time series of cost. The investor group said that they felt that we should align different risk scenarios for policies focused around different socioeconomic situations, which is also what has been discussed at the IPCC level. So you can see these are called shared socioeconomic policies. It means, of course, over the next 30 plus years, the socioeconomic setting will change. And it's going to be different, take different efforts to accomplish a 2-degree scenario or lower or higher, depending on that socioeconomic scenario. So what we did is, I just wanted to say, in the beginning we had this. This is basically the emission reduction profile of the world before the project started. And after the project, we had something like this. You can select between several different kinds of trajectories to reach a long-term goal. And we have aligned ourselves with different integrated assessment models. You can see here on the left 2 of them that we decided to effectively integrate data from these integrated assessment models so that our data and our outputs reflect what large consortiums of researchers also think would happen under these scenarios. This is what the Potsdam Institute's Riemann model says that a 2-degree, how the temperature to hit 2 degrees or stay below 2 degrees would look like according to the Riemann model. And again, this is now what the 7 different scenarios developed under this group would look like. So you can choose a little bit of how you think we might get there. It's not, no scenario is 100% right. It's very difficult standing here to say exactly what pathway we will be on. So you can select your scenario, you can select all of them, you can have a look at what the risk is along a different pathway. I think it's very important. I can say that one message that we heard very clearly throughout the project was that the more data, the better, the more variety, the better, the more extremities of the exploration of the data is available is better. And so this is what we always tried to achieve during the project. So now I'm going to talk about opportunities because our model also integrates, as I mentioned, a view on which companies are better positioned to transition themselves. And what we decided to do is we looked at an extremely large database of around 70 million different patents. And what we do is we look at what kind of patents are companies filing. It shows, of course, what their R&D departments are doing and what their management thinks are the goals for the future in terms of the products that are being produced and the technologies that are sold. And I think, interestingly, this slide was prepared before yesterday when we just had a big announcement from Siemens. So you can see that transition is happening yesterday and today and every day. And this does, this patent database basically shows that there's more than 10,000 companies that have filed low-carbon patents over the last 20 years. And some of them doing it at a surprisingly significant rate and have been increasing the number of low-carbon patents that they file. Effectively, these photos and descriptions are just saying that there's thousands of technologies out there. It's very difficult for any of us sitting in a chair to have an idea of all the myriad of technologies that we'll need to deploy in order to reach a climate change goal in the future. Some of them will be relatively well known, like these 2 here. Others will be extremely innovative, like nuclear fusion reactors, new drugs, new ways of producing drugs. And companies are certainly, I think, shifting in a very interesting way, and this patent database has allowed us to have a nice look inside of R&D activities. So for us, what we decided was it was an innovative but relatively simple way of looking at transition. It's to look at patent databases, assess if a patent has high quality and high potential. These patents could have green revenues, which can equal also green profits. And basically, green profits mean opportunity. And different scenarios, depending on, of course, the technology mix of the future, for example, mean more or less opportunity depending on the kind of technologies your company is producing. And last but not least are the physical risks. So carbon delta, our methodology is something quite similar to what you would find in an insurance company or reinsurance company. It's the simple combination of, well, several data sources, but let's say at a high level we'll just call it three methods that come together. First is an understanding of facilities. The second is an understanding of how climate change hazards will evolve at that location over the future. And the third is to understand if that evolution of the changing climate is going to be create an opportunity or a risk for that facility. It's the 3 that are listed up here: exposure, hazard, and vulnerability. And we do that across 7 different hazards. You can see them listed here. We're also adding a couple in the near future, but this is effectively what we could do over the course of the year. And where we've gotten to at this point, we'll soon add wildfires as well as fluvial flooding. But again, before the project started, we effectively had something like a business as usual scenario. And at the end of the project, we had two scenarios, one business as usual average and what we call a worst case scenario. And effectively, I think that is almost the end of my presentation so that you have an idea of where we've gotten to in this project. As I said, once again, we've actually learned a whole lot by working with this group of investors, and it's been very exciting for us, and we're really grateful for not only those investors who worked with us, but all of you who have come to this event. Please come celebrate with us tonight. I think we're all in an interesting point of understanding about climate change risk modeling, applying data, and I think all I wanted to do is show on this slide that there's lots of use cases. This is also not an exhaustive list. So thank you very much for this opportunity.
Is it working? Okay. We have a little bit of time. We're running late, of course, as always. But we want to make time for 10 minutes or so of Q&A. So if there's any questions from the audience, raise your hand. There's two. There's a lot of innovation here in the room already on these types of things. There's two mic. I don't know what you call them. Floating mics. So if you dare, you can raise your hand, and one of these will be thrown at you.
Yeah, you can actually throw them. I've also been told that once you catch them, you're meant to speak into the black dot. So let's try.
Okay. So, thank you for your excellent work and sharing with us. I'm Efrain, a researcher in energy and finance from Hitachi, and I wonder how this work could actually help prioritize the investments, because as we move forward, it's better if we can actually compare the net environmental contribution of each project per invested capital, so that we can prioritize and compare projects, as well as we need more information, more transparency, what suggestions can be there so that we can ensure that. Thank you.
Shall we take a few questions, perhaps?
Sort of works. That's great. In regards to the modelling, I think there's always a challenge about the interactions. And sort of like, so the bottom up can work, but it's how will these interact? So if you think, how are you thinking about inflation and interest rates, those border effects, and also potential of, migration, and actually how it may be the sort of the customers that actually can't buy the goods may actually be the sort of different aspects, and or more sort of nation worries about sort of migration and everything leading to protectionist type policies.
Okay.
I think actually what we'll do is we'll have you throw them or pass them to one another. That's the intent.
Peter Yellenbrook from Share Action. Fantastic presentation, great evolution of these tools. I'm curious, of all these different applications of the data, which one of these has been most popular that investors are using it for?
Okay. We stop here. We have 3 questions, and then we might have a little bit of time for a second round. I can have a first quick attempt at the first question as to how can all of this then help prioritize investments or action. And to me the answer is it's quite simple. Once you start as an investor applying these methodologies, you will have at the end of the process an indication of an upside value at risk, but also a downside value at risk. And you will do that, and you can slice and dice, that one metric in using your portfolios to different sectors and to different regions. And once you do that, you will fairly quickly realize, where are there on your portfolios the hotspots that where do you on a portfolio see the highest risk exposure or opportunity for revenue, both on transition and on physical. And that already is huge guidance on which segments of your portfolio to focus on to either maximize the upside and mitigate the downside. We had a second question which was about the modeling and the relationship between, I guess, various variables, macroeconomic and microeconomic, etc. Do you want to? I mean, this goes to, I think, to the gaps. I think in the gaps in the methodological landscape, and to, from my understanding, two of the gaps that we still see quite a bit at the moment is modeling, climate-related modeling that happens through macroeconomic variables. That's not yet much covered, but you'll hear during the panel discussion later on. We have one firm here who specializes on that, Wilhelmine from Ortec. And your second question was also around markets. So at the moment, when we're doing physical risk assessments, we're focusing quite a bit on the companies that emit and then that will be affected, say, by a carbon price. But many of the riskiest companies will not be affected, such as oil and gas. Oil and gas companies don't emit a lot of emission beyond methane themselves, but it's through the markets and through the products that they sell that risks will manifest for them. And here again, I think there's more need for methodological development on those aspects too. But any more points on these two questions? And I'm not forgetting about the third question.
I think you covered it quite well, and I think that's right. The particular challenges, the really difficult challenges of the full macroeconomic set of variables will be interesting to hear from Ortec, and there's others that have looked at the macroeconomic side. That even that itself covers wouldn't cover the breadth of things like mass migration from disaster. So there's many layers, and it's still a challenge. So there's emerging methods which I think are good, and we have to be honest that they will be very hard to predict and hence hard to model. And I think that's going to be, look, we saw the expansion of the scenarios in this report, and that's just the tip of the iceberg, right? In terms, I think you're going to have to be thinking more and more about quite a wide range of scenarios. The other thing I would say, in passing over to David, I think he'll probably eloquently speak to, there's quite a lot of merit in starting with some of these direct impacts. Yeah. I wouldn't undersell that as a valuable exercise. And let David maybe sing the praise, though, more eloquently.
That's right. I guess I firstly would just say that, we align most of what we've done so far with a predefined integrated assessment model, at least where we find data that has already been modeled through a big global model. We don't try to tweak too much. We can, and we have, just to test how the model works. But within each SSP, as I mentioned, there's 5 of them. Of course, a different interest rate, a different price of oil or gas, a different this or that. So, we just reference, depending on the SSP and the underlying integrated assessment model, what has been assumed for that in that particular scenario. And yeah, I think I really enjoyed when I heard Chris say the polluter pays principle. It's not easy to say very quickly, but it's extremely important to always think about is that obviously costs will be passed on, and there'll be numerous, probably almost an infinite number of side effects of climate change. But at least in our modeling at the moment, the direct impacts are what policymakers will always try to focus on. Who pollutes? Where's the source? And how do I prevent that from happening? Rather than going 3 or 4 levels down a supply chain and trying to attack it by some other method. So I guess at least in this starting point, we're looking at the direct impact and not trying to, let's say, look too far down the line. The more down the line you go, the more assumptions and variables you have to consider, of course.
And thank you. And just on the third question, which was out of these, follow-on actions that investors are now enabled to start looking at, more seriously perhaps than in the past, based on the assessments and the new savviness. Have you, from your clients, within our investor pilot and beyond, have you received any feedback on which ones are the ones that they would prioritize? I think that was the question.
Yeah, that's right. Well, it's hard to say that there was just one. There's definitely been, I think, differing degrees of interest, but there's what I can say was the thread that ran across the entire project is, I mean, each investor that participated really wanted to understand how this works.
Yeah.
So I think that while some may have personal or internal interest, depending on their organization, you know, of physical impacts or a physical impact, you know, they're interested in the whole modeling process. Yeah. So at least I felt like they took the experience, even those all the way out in Australia, to try to really engage and to understand, you know, how is Australia and extreme heat, how does it work in your model? Yeah. And that, you know, that's just one example, whereas, you know, I really think, yeah, each investor, some of them, of course, are asset managers, others are institutional investors. Sometimes they're very small portfolios, sometimes they were extremely large. So some of them wanted a bit of a higher level view, sometimes they wanted to get extremely security specific. And of course, that's why I think there's definitely interest, but I can't say there was just one that everyone kind of gravitated towards. It was depending on a particular use case or something internal that resonated with their organization.
Okay, no, thank you. And I think in this context, and then I think we'll have to move on, I would just like to highlight one perspective that is very much, I think, a perspective from us at UN Environment, which is that, you know, the TCFD and, you know, these resulting frameworks and logics, you know, they do tick many of the right boxes, forward-looking, they translate climate impacts into financial metrics, etc. But from our perspective, they don't necessarily tick all of the boxes, at least not the TCFD framework, the way it's configured. And that's because the TCFD framework is a framework towards mandated to ensure financial stability. And not necessarily environmental stability or climate stability. And I think the idea is a little bit that as investors do these assessments and as investors try to start to implement these activities, of course, many of those will have the double benefit. They will be contributing to financial stability and to the resilience of their own portfolios, and they will also be sending signals to the economy to decarbonizing, green economy. But that's not a must. You can think of situations where investors will reduce the risk in response to TCFD, in response to these assessments, and actually not do too much, or the outcome in terms of greenhouse gas emissions and decarbonization might not be immediate. An example, for instance, on the adaptation side that's being discussed quite a bit is, and there might be others, is you know, if certain countries are forecasted to be impacted quite heavily by physical climate change, you know, some prudent investors might decide to withdraw from those countries to avoid those risks. And then there's a question around the extent to which that might then inhibit those countries' capacity to finance adaptation to climate change. So this is one example, and there's probably other examples, and I'll stop here. And I think we'll have to move on to the next session and to the coffee break. I think we're having a coffee break until...
Let's say 3 o'clock. I think that gives us a 15-minute coffee break.
Yeah, thank you.
So we can all be back in the room by 3.
Thank you. But thank you.
Good afternoon again, everyone. Thank you for joining us for the second half. We were supported throughout all of this work by the consultancy firm Carbon Delta, which you have already heard from today. They made tremendous leaps and bounds in supporting the group of investors in making this research and the results much more detailed and nuanced for particular needs. It is my pleasure to welcome Anya Lutsuvai, who is the Director of Business Development at Carbon Delta. She joined the company in April 2018. Her main responsibilities at the company are new business acquisition, client relationship management, and she is also the product manager for the online tool that we are presenting next. Prior to joining the company, Anya knew co-founder Oliver Marchand from her time at carbon market data provider FactSet, where she held a number of commercial roles. Lately, she has been setting up strategic partnerships for new and innovative use of FactSet's content offering. Sorry, I think that's a mistake. She will present the tool to you now based on the work that she's done recently with Carbon Delta. Thank you very much.
Yeah, thank you, Jessica. When I joined Carbon Delta just over a year ago, really, during the very first week I was in office, we actually started writing up the RFP response to the very project that we are launching here today. And so this project is kind of very close to my heart because it was really the very first project that I got involved in when I joined Carbon Delta. And at the time we were a much smaller team, so there was less than 10 people of us, and pretty much the entire team actually got involved into writing up this response to the RFP. And I mean, about 2 months later, we learned that Carbon Delta had actually been appointed as the data provider to help this group of 20 institutional investors pilot the TCFD recommendations. And I can say that since this time, when we were appointed, was all very exciting. The team has also, I mean, the model has grown, what David showed earlier, but also we have grown as a team, literally, and we are now much bigger as a company also. So I think in many aspects it has brought the company ahead. And I mean, why the tool, you may ask, you know, why does it need such a tool? And, you know, I very much think that it needs the tool in order to perform this analysis much faster and much more efficiently. I mean, as we saw here today, this topic of climate scenario analysis is actually very complex. And I think we really need very good and transparent tools that allow for a very efficient and timely analysis. And you know, when we started working on the project, the tool didn't exist at all. And I also have to say, this is the very first live demo that we are doing of the tool, so I'm just a little bit nervous. But yeah, let's look at the tool. So can we have the screen? Thank you. Yeah, so what I'm going to present to you today, you all know that we are launching this report, and the report, when you actually look at it, you will see that it's made up of a number of different sections. And when you open up section 4 of the report, you will basically see the portfolio analysis that was carried out by Carbon Delta. And part of this portfolio analysis are actually these very 4 portfolios that you are seeing here on the screen. So the most important portfolio that was also mentioned by Remco earlier is the market portfolio, and it basically consists of the entirety of the publicly listed securities that we cover. So it's an equity portfolio of round about 30,000 securities. It's equal weighted, and you know, the analysis should really show you that the risks, the climate-related risks, are urgent. So if you look at this portfolio here, you can see that It's minus 8% in transition risks, it's minus 2% in physical risks. So overall, there's about 10% of the current valuation in assets at risk of this portfolio, which is quite sizable. But then on the positive side, there's also technology opportunities that David talked about earlier. So companies are not waiting around. They are already working on this transition. And that is really helping us to offset some of that quite considerable risk. So you can see here that with the market portfolio, it's getting close to plus 7% in technology opportunities that all of these companies are working on. And then there's also a top 1,200 companies portfolio. The reason we picked that is really because it's basically the top 1,200 companies, the largest companies by market cap. And it's very close to a benchmark that many of you are familiar with, the MSCI World. So for that reason, we wanted to show it. And you can see that there's the benefit of diversification in this portfolio. You know, on the aggregate level, you know, and at first sight, it seems that these risks are somewhat low, but then it's always very necessary and interesting to actually dive deeper into the analysis. And then to basically broaden the picture, we also wanted to show you a sort of portfolio that's more on the negative side. So this is called our coal portfolio, and it basically consists of public coal utilities around the world, about 50 of them. So it's really a coal divestment portfolio, you could say. And then there's also a renewable energy portfolio, which consists of very innovative companies. You know, we actually picked, for example, manufacturers of solar panels or wind installation systems, but there's also Tesla in there, I believe. So you can see the middle of the road, you can see the upside and the downside. And I quickly navigate you around how easy this is. So we can, for example, very quickly, we can sort our portfolio to very quickly understand which are the most positive and which are the most negative portfolios. I mean, here we have just 4 portfolios, but when we work with our clients, we often have to upload 50 or 60 different portfolios for them, and you know, this sorting actually allows you to very quickly see where the hotspots are in your investment strategies. Also, what you can do here is you can do very efficient searching. So I could, for example, just search for coal, and that will then filter it for me. You know, there's a number of different analyses that I can see here already on the top level. So I can, for example, see when I click on this coal portfolio that is now highlighted, I can see the allocation by sector, I can see the allocation by country, but I can also see the temperature of that portfolio. And then to the very right is the actual average temperature of all of my portfolios that are on the tool. And then I can click around. So for example, if I wanted to see how does this coal temperature of 5.34 degrees actually compare with renewable energy, I can click on here and I see obviously it's much lower. Also here to the right you have different buttons. So you could, for example, click on this PDF button to actually get the underlying visualizations of this portfolio. But then you also could click on the XLS button, and that will actually give you the underlying security content that we provide here. So I also wanted to quickly open that up to show you that the model is very transparent. So there isn't just a few metrics that you are getting, but if we are actually opening up the security data here, you can see that overall there's about 44 different data points that we would actually give you on all the securities in your portfolio. So it's quite comprehensive. Then also you could click on this view button here. Sorry, I forgot to mention one thing. So there's also these 3 buttons here at the top, which are very important. I mean, you as an investor, you're probably wondering how easy is it for me to actually work with this tool. And in order to do that, we have basically added this upload portfolio button at the top. And I quickly wanted to show this to you because one of the advantages of using this tool is that the input requirements are exceedingly easy. For example, if you wanted to upload a portfolio of equities, all you actually need is the ISINs of the holdings in your portfolio and the associated weight. And if you have it, you could also provide a security name. And then on the corporate bond side, which we also cover, you would then add a few additional security types like the actual security type, you would add the maturity date and also the ultimate parent ISIN. But you can see that the input requirements are actually few, and we really worked with the investor group also to make that as easy as possible so that you can actually do this analysis very efficiently. So let's go back now to the dashboard. Okay, while this is loading, David is already talked about these different scenarios that are also available here. So at the outset of the project, we had only 3 scenarios available from Remind. And now we actually have a total of 7 transition scenarios. And if you basically go on the scenario button here, you can basically see that we have now integrated all of them into the tool. So it's now very easy for you to switch from one scenario to the next. So if I actually click on this drop-down box, I can basically see all of the scenarios that have been added. And then the same thing on the physical side, I can basically choose between the average and the aggressive physical scenario. And then last but not least, what was very important for many of the investors was really to have a comparison, to have a benchmark. I mean, you basically want to analyze your climate-related risks, but what does it actually mean? So it was very important to the group that we could also perform this benchmark relative analysis. So let me just quickly load that again. And then you see here at the top that we also have a benchmark button here. And basically, any portfolio that you upload on this tool can also be used as a benchmark. So I can actually click in here, and then you see that basically any of the other portfolios that are on the platform could now be selected as my benchmark. So I have already done that now for the coal portfolio and also for the renewable energy portfolio. I have selected the top 1,200 companies as a benchmark. Okay, so now let's look at some of the results. So what do the actual underlying data look like for these portfolios? And we really wanted to focus on the positive side today. So I'm actually going to jump into this renewable energy portfolio to point out also some of the upsides that we have in this climate transition. But I also tell you another reason for it, or the real reason, is that this renewable energy portfolio consists of only 15 securities, so it's actually much faster to run. So that was another reason we picked it for today's analysis. If I click on this view button here, it will actually open up the renewable energy portfolio. So on the very first tab, you will get some basic information on, how many securities are in that portfolio, what is the overall climate value at risk. It's very positive at plus 40%, also allocation by sector and so on. But then what's interesting here is really this, if we jump through to the VAR analysis. So here we can basically appreciate the breakdown of these risks. So the technology and opportunity, we already saw that on the dashboard, but we can now also see the breakdown on the physical side. Carbon Delta is actually modeling 7 extreme weather hazards. So all of them are actually shown here, and you can see how the assets in that portfolio are affected by these extreme weather hazards. Then the next one is the scenario detail, And here is another very good reason and an added advantage for having such a tool, because we really wanted to provide a granular drill down to the security level. So at any point you are in your analysis, you are probably sometimes wondering, why is this company so positive or so negative? So we really wanted to make it very interactive and allow you to basically understand the underlying company data at a click of a button. And I mean, all of these high risk and low risk companies here, they are basically highlighted, so you can click on them and then drill down to the underlying company level. So I'm actually picking SunPower. It's a manufacturer of solar panels. So you know, we would expect them to basically be ahead of this transition already and come out very positive. But what's also interesting, Carbon Delta is modeling the asset facilities of this company, so you can actually see here where they are located. The very next one is the transition opportunities. So I just wanted to show you, highlight some of the data points that you can expect to get. So we basically, as David referred to the polluter pay principle, you can basically see here the scope 1 emissions that the company currently has and is expected to have in 2033, so in 15 years under a business as usual scenario. You can also appreciate the associated costs under the 3 different temperature scenarios. So the main ones here modeled are the 3 degree, 2 degree and 1.5 and the associated costs. And then of course we have our patent analysis. So further down here you can basically understand you know, the type of patents that this company works on right now. And you can also see the actual ratio of low carbon to all patents that the company works on. So for SunPower, this is very high at 82%. That's a very high ratio. And as a result of that, they basically also capture in their peer group a very high amount of low carbon patent value. And you can also see how the company is developing so that more and more low carbon patents are actually being filed in very recent years, which results in you know, a lot of low carbon and green revenue and green profit potential. So let's go back to the portfolio. Let me just jump back now. I'm actually going to jump in here. So in this portfolio, I have the underlying security detail. I can also very quickly spot what are my climate relevant hotspots. So here I can immediately see I have capital goods and I have utilities which are climate relevant, and I can immediately identify the underlying securities. Now this portfolio is very concentrated. Normally you would actually see a much more granular detail. There's one additional chart that I wanted to show you, and that is the benchmark relative that I talked about earlier. So here we are actually identifying the main sectors that the assets of my portfolio are invested in. And I can see here it's utilities, automobiles, semiconductors and capital goods. And the blue point actually represents the weighted average of my portfolio holdings. And then the gray bar that you are seeing is actually the benchmark. So you can actually now see in each sector, how does my portfolio investment compare to the benchmark? And then what's also very interesting is the spread in each sector. So basically when we look at a sector like capital goods, there are some companies there which are at minus 100% climate VAR, and then other companies which are at plus 100%. So now, because we have that transparency of the data, it will actually allow us to really rebalance our portfolio in each sector and find out how we can invest more climate friendly. Now, let's look at a few more aspects of our analysis. So as David also mentioned, we have the technology opportunities, and also there we basically have quite a granular data set that we provide. So we basically not only provide the low carbon patent value, but we also look at the overall patent value that the company has. So interesting here is that General Electric stands out. But then when you look at the second last column, the green percentage of low carbon value to overall value, you basically find that there's other companies which are much more ahead, like Vestas Wind, SunPower, and so on. So that also allows you to get a sense of how far is this company in the transition to low carbon. And then there's one last point that I wanted to show, and that is really the asset facilities of all the companies in my portfolio and how they are affected by extreme weather. And you can basically see there's a number of hotspots also. You know, there's some company facilities in the United States and also in South America that are affected by extreme heat. There's also some flooding risk there represented by the blue point. So it really helps you to understand also, from a physical perspective, are there any hotspots in my portfolio? Now I've been told I shouldn't actually drill down because we really don't want to give negative publicity to any of these companies in here. So I'm going to stop it at there and not show you the underlying companies. But of course, if you uploaded your holdings, you would then also see the underlying companies. And yeah, this is really a wrap-up of the tool. I hope you found it interesting. And yeah, we are now here to answer any questions that you might have.
Thank you, Anya. David, would you also like to join us? Thank you very much. We wanted to take a few questions from the audience. If I could maybe have the front row there grab those balls. We can toss them around. Any questions from the front row? Please.
We're working in a fund management institution. We get used to outperforming a benchmark by a few percent. How much do we have to outperform your benchmark to get to 2 degrees? To 2 degrees. So you put up the benchmark, we're out, we're above, we're below. Some of us as fund managers would look at that and go, that's fantastic, we're on the right side of the benchmark. Yet the underlying benchmark is financing chaos. How much better than the benchmark do we have to be to get to 1.5 degrees, 2 degrees? To outperform by 100%? Is that? I'm trying to understand the delta on the benchmark. So if you're carbon delta, what's the delta we need against the benchmark to know that we're doing well?
But I think you didn't get to touch on the temperature gauge.
Yeah.
Yeah, so I wish we had all the answers for you there.
Sorry.
But yeah, David.
Well,
I
think the only answer is that no one financial institution can do this alone. So there's almost no way that there's just one way or one institution that can solve the problem. Or I don't really see a way for, I think everyone needs to try to outperform the benchmark, right? Is that your question? What is the market's benchmark, or what institution's benchmark?
I guess if you're a fund manager and you're used to a really quick answer, at what point can you relax that you're outperforming sufficiently to have managed your climate risk? How do they assimilate, if they can outperform the MSCI by a few percent and relax? What is the same point with your benchmark?
What is our benchmark? The market portfolio?
Whichever the benchmark you're putting up, your created one.
Well, the benchmark depends on the scenario that you select. For example, I mean,
okay.
So the benchmark could move. I guess it really has to do a little bit with you as an investor taking your own view on how you think the world is developing. As I mentioned earlier, maybe the shared socioeconomic pathways is also something to think about. You know, if you think the world will evolve more sustainably or more fossil fuel fired, then you want to select this as your benchmark, one or the other as your benchmark of the future. So I guess I just wanted to say that the benchmark can be slightly different. And I think it's also this climate change is of course a problem that is utterly driven by public policy, or the solution will be driven by public policy. So I think national governments, or even at the global level, there needs to be a benchmark that is set. Yeah, but I mean your answer is also very technical, so I would just say the more technical part we should probably discuss in the next coffee break.
Yeah, can we take maybe one or two more questions, and then maybe save a little time for panel. There's one there, and there's one in the front row here. Maybe we can take this first. Yep,
Good afternoon. I was wondering if you could speak a bit more about other applications, other sectors, real estate, for instance. What are your next plans, and particularly entering areas where the data is not so abundant as securities? How will you manage these challenges and grow the tool?
Okay, so a question on real estate and future growth, and then a question here.
Thank you very much. Extremely interesting pilot and the presentation. I would like to know, what is the percentage of the estimates that you're making on the data that is available? Because that actually goes back to what Steve says as well. How can we as investors get one number, and how can we rely on the data that we have access to? Because being in the investment business, sort of looking at it in that way, we try and just understand what is the estimation level, percentage of the estimation. Of course, different sectors, different estimations, but that would be interesting to know. Thanks.
Anya, would you like to start?
Sure. I'd like to talk about the percentage of estimates on the different sectors. So here it obviously also depends on the strategy that you are invested in and the benchmark that you are picking. But yeah, it's very interesting to actually see on a sector level the results that we are getting from the analysis. And obviously there are certain sectors which are more climate relevant, and that is also immediately identified in the analysis. And I mean, there are some usual suspects like, for example, utilities and oil companies, for example, that will come up there. But the interesting part of our analysis is that we're actually covering the entirety of sectors. And that was, I think, also mentioned earlier, that climate change is really affecting all the sectors. And we can basically identify in each sector what could be potentially climate relevant hotspots. So there's many other industries that are also affected, like concrete, steel manufacturers, and so on. And I think the added value of the analysis, then we can basically see, this is basically a concrete manufacturer. It's very carbon intensive, but then you can also see which companies are already further ahead in the transition by looking at the patent value. But I mean, I can't give you concrete numbers now, but would be very interested to look into that on your concrete strategies that you're managing.
Well, I think, these are great questions. Firstly, let's say, confidence level related to certain outputs of our data set certainly varies. I think with, for example, the confidence level that we have of certain extreme weather hazards that we model, I think we are in the process of fleshing out hazard-specific confidence levels. But I think, at least at this point, we have had to make some big assumptions in the model. One is that we assume that the companies will continue emitting at the same, that their business model stays the same, and that they continue emitting greenhouse gases the way they are now. Taking that big assumption, I think it's very, very difficult to try and apply an accurate estimation of what that assumption means in the future, when we all know that that big assumption will not be true. We've never really explored what that does to what's the probability of that, or what's that, how big is that assumption? But I can only say that we explain all of our data sources in the way we model climate risk at the moment. They're big assumptions we had to make. We don't exactly know what the probability of the underlying result is, because they are big assumptions. And I guess to be honest, this is an issue throughout all of climate science, right? Climate scientists have a hard time giving you a probability of the data they produce, an extremely, very confident level of probability. So, I mean, it's a good question. I think we all know climate change is happening. At least that's just a fact throughout all data sets. But how much can you rely on one model versus another? I think it's something we have to learn about into the future. With regards, maybe I can go on to the real estate model. I don't think we have a deadline set yet, but we have roughly put in place, let's say, a first version of a real estate assessment model. And I can say on top of the real estate model, which we will, I think, finalize towards the end of the summer, we're also looking at loans covering private equity. Basically, I mean, a lot of what happens when we cover loans or private equity, I mean, this is looking at how much a company, as you said, how much risk a company might have when we actually don't have a lot of information about them. We haven't solved all of these issues yet. I mean, I would suggest that we speak after the event to outline a little bit and further what the route we're going. I think we can take some of the data that we have now on sector, also location information, and try to apply that to a shell company, if you want to call it that. And also, of course, something we're looking at with regards to real estate are, that there are a lot of, I mean, real estate investors have probably a lot of risk in terms of the risk embedded in their tenancy schedules. So we also need to look at, some companies that occupy buildings are listed, others are not. So that same, let's say, general approach to modeling a company in a sector and location needs to also be applied to the tenancy risk model that we're currently working on.
Thank you. Just in the interest of time, I'm sure we've got a lot of really good questions, but want to thank Anya and David and the team again for a tremendous piece of work, really showcasing all of the efforts that you've been developing as from the start of your consultancy. So thank you very much. Really great piece of work. And with that,
thanks, Jess.
Yep, thank you. With that, I would like to introduce my colleague to you, Elodie Feller. She won't be unfamiliar to many of you. She is the investment lead at UNEP FI. She's undertaken a tremendous amount of work at UNEP FI over the last 7 years of her career there, and comes from a private sector background prior to that. She also leads the fiduciary work at UNEP FI and will be here to moderate the panel. Thank you, Elodie.
Thank you, Jess. And if I may invite the speakers on the panel, Margaret, Steve, Jenny, please. So good afternoon, everyone. Please take your seats.
Go ahead.
In the order that you prefer.
I can go here. Yeah, we can do it this way. Yeah.
Stop a bit.
Are you comfortable, Sasha?
Yes.
Okay, good.
Yeah. Cool.
All right, so good afternoon, ladies and gentlemen. My name is Elodie Feller, as Jess mentioned. I work with UNEP FI, where I lead our investment work program, and it's my pleasure to be moderating this session today. This is a high-level panel and closing session for the launch of our UNEP FI TCFD investor pilot. I think we can use acronyms at that stage in the program today. I have 4 excellent panelists with me today, and I will start by introducing them straight. So we have Sasha Bissik, who's the head of Group Sustainable Finance at Nordea. Sasha, you have more than 15 years of experience of advising and working with multinational companies on investment issues, including ESG issues globally. The web describes you, that's not on your official bio, but it describes you as a former refugee and humanitarian journalist.
Yeah, that's correct.
Who's passionate about finance and sustainability. Nordea Asset Management participated in the TCFD pilot, and so thank you for being with us today. Guillemine, you're the co-head of climate and ESG solutions at Ortec Finance. You've got 15 years of experience as well in the space of climate risk finance and policy. Your current focus is on forward-looking scenario-based strategic modeling tools. It's great to have you here.
Thank you for having me.
And you previously worked at the Dutch Treasury and Foreign Office at climate finance, as the climate finance lead for the Dutch UNEP FI negotiation team. Steve, where to start? You're the Chief Responsible Investment Officer at Aviva. Aviva obviously participated in the TCFD pilot. You chair the Corporate Human Rights Benchmark and the World Benchmarking Alliance.
I chair the former, but not the latter.
You chair the former, not the latter.
I'm involved with the latter.
Okay, you're involved. Okay, sorry for that. You co-founded our UN Sustainable Stock Exchanges Initiative, so I hope I get this one right.
Yep.
As we also co-convene the Sustainable Stock Exchanges Initiative. And most relevant to our discussion today, you're a member of the Financial Stability Board Task Force on Climate-Related Financial Disclosures.
Yes, although I didn't call it the TCFD. Please don't blame me for that.
Very right. We got over that in some time. Margaret, so you're the finance practice lead at the WWF. Previously, you worked as vice president in the Office of Investment Policy at the Overseas Private Investment Corporation, which is the US government's development finance institutions. You bring 25 years of work experience, including on sustainable finance. Thank you for coming all the way from DC to be with us today. That's much appreciated. So this is a very exciting moment for me, for the UNEP FI team, and for UNEP FI investment members to be launching the results of 12 months of work, trying to apply, developing methodologies, and then applying these methodologies and scenario-based analysis onto their portfolios. We are 2 years approximately into the TCFD journey. Obviously, the climate disclosure agenda is not new. We got some insights in terms of the innovative aspects of the TCFD framework. One clear message I think that comes out of this report, what you haven't been told yet, is the report is 129 pages. So the main key message that we try to highlight here, and that the results, quantitative results reveal, is that indeed, the more we wait, the more the policy makers wait, the more investors wait to take action, the more damage there will be on portfolio financial value. So there is no need to be waiting. And we're talking about costs and losses in the ranges of trillions. That was said previously, of asset under management globally. So no need to wait. I'd like to take the opportunity of this sort of milestone, 2 years into the process, to discuss with our panelists how far we are on the TCFD sort of disclosure, climate disclosure journey. What have we achieved? What is to be achieved on the climate disclosure front? And then obviously take the opportunity of your insights and expertise to take us through what you think should come next. So beyond climate disclosure, beyond climate risk, what you think should be best. And so, Sasha, if I can start with you. As said, Nordea Asset Management participated in the pilots. Quickly, straight, Sasha, if you could elaborate on what climate risk and opportunities mean for a large institution like Nordea.
Thank you very much, and I think the work that's done by UNEP FI and all the partners has been probably the first serious attempt by industry to join forces, to understand the impacts, to understand the challenges, but also to see how we can together create the understanding of how little we know when it comes to the companies and the investee companies that we're investing in, and they're reporting on the risk side as well as on opportunity side. I think from Nordea point of view, we've been in this space for a very long time, and Nordic countries are leading in many cases in this field. I think the team that worked with this had great experience working and collaborating with others. But however, one of the key sort of outcomes that I got from one of the team members that technically has been involved in this very much is that he told me before I was traveling out to London that, you know, Sasha, industry truly does not believe in this. That's what he told me. And I was asking him, Emil, what do you think about this? And he said, you know, if you look at it, they should believe in it, but we are not there yet. So I don't want to spoil the party, but I think we understand, people in this room and the professionals, we understand the importance and the urgency of it. However, I still feel that in many places in our own industry, we are still struggling with answering the question that Steve asked about the performance. How do we make money on this? And where are the areas we're going to lose it? And I think one of the questions and the questions that I asked to Carbon Delta on the estimates, it's one of the troubles and the problems we have when we talk to the professionals in our own sort of a business, and that is that how certain is the information we're going to use? Because if we're going to push it too hard and it flips back and it shows itself not to be accurate, we're not going to get too many shots on this one. So it's going to be, you know, a bit complex from the angle of making these people believe in it again, or convincing them that the underlying information is okay. And I think, as I said, it's a first attempt. I think it's a serious attempt. It's great. It's global. But in the same time, I want to emphasize the other thing, and that is that our understanding now of how little we know about the companies that in information and the data sort of accuracy, granularity of the data and all of that is quite alarming. Because it puts us in a position where we are aware of the fact, we are aware of the risk, we might see the opportunities, but we actually, in our own models, don't know exactly which path to take. And I think one of the takeaways from me, from this sort of a launch, and also from listening to the previous panelists and to people's questions, is that we should, in the next phase, have a much closer, I think almost like a global cooperation with the corporates that we actually do business with. Because that debate needs to be a far more accurate, and I would say emerging very quickly, because we need the data. And data, not having a data is not excuse, and I don't want to use that, because many in our industries, in the financial industry, many people are using that as excuse of not doing anything. But it's more of the fact that it is so urgent that we need to intensify that type of a dialogue with the corporates. We're going to use a lot of lessons learned in our own sort of asset management side of the business. We're going to use both the insights in terms of how the risks can be interpreted, and also how the opportunities could work in terms of the calculations. The first part of this day, where we had a professor from Oxford, was it, or Cambridge? Cambridge? I'm sorry. I'm sorry for that.
I wouldn't know.
You know, different countries, different customs. I don't know, but
they lost the boat, right?
Yeah. So he had a very interesting takeaway for me. I mean, this is what we discussed. I mean, what is the price of the carbon emissions? So how do you price that in? If we have a price, we can price it in. It's an easy game. We also know, everybody in this room, we know that the 100 companies emit 72% of industrial emissions. We know that. Why do we need to make science of this? We know where they are. We know where they operate. I mean, we know who owns them. So how complicated do we need to do this to make effort? So, I mean, yeah, I don't know. Sometimes it feels that we make a sort of a rather complicated things of the things that we already know. So that's one of the takeaways as well. But now I'm going to leave other people to sort of a chip in.
No, this is a very interesting perspective in terms of making the case more simpler. I think what was shared earlier about the advantage of the TCFD was that it would, bring that financial perspective onto the desk of the CFOs, the CIO, the CAO, bring that financial perspective into the picture of climate change. And so if it's not achieving that, then indeed there might be other things that we need to think about and do. Margaret, if I can come to you. I mean, how much is, and that's bringing one step further, I guess, in terms of thinking about the broader climate and environmental objectives. How much is this TCFD disclosure framework, voluntary disclosure framework? How far? How much is it actually contributing to the broader climate objective, in your view? As in, if we were to implement this very complex scenario-based analysis and we were to find the magic figure in terms of climate risk and opportunities, would that solve the climate issue? Would we have a net zero economy? And if not, what would need to happen?
Well, the short answer is no. But it's a great place to start. I think.
Depressing.
Yeah. I think first, thanks to UNEP FI, this is really great. The report's really great, in addition to the report on banks, because it pushes this forward, right? Because first and foremost, it needs to move a lot faster. And thanks also to Vivid Economics and Carbon Delta for the great analysis. As a recovering econometric modeler, cool. It's my main takeaway. But I also think it's important to remember why we're having the discussion. So why do we care about climate disclosure in the first place? And the IPCC, the Intergovernmental Panel on Climate Change 1.5 degree report was meant to show us what happens in the difference between a climate that warms at 1.5 degrees and a climate that warms at 2 degrees. And just to pull out one data point, there's about, at 2 degrees of warming, there are about 2 billion people who will be affected by extreme heat waves every 20 years. 2 billion people, about a quarter of the population. Think about the most recent heat waves that you yourself have experienced wherever you've been, because you all have experienced one, guaranteed. And put that around the world, we're looking at a climate refugee status that's quite alarming, and roll the impacts out from there. So it's great analysis. It's really important to apply this portfolios. These are really great tools for investors to try to find ways to better meet what we need to meet, which is a 1.5 degree world. But we also have to remember the reason we're doing this is because no one wants to live in that world. And as we saw, if we roll out the NDCs, we're looking at something more like 3.5 degrees of warming, like truly alarming. I think, I'm glad you said voluntary. What has to happen next, these recommendations need to become mandatory, because the reason they were put in place was really, I would say, twofold. One, to make sure that we can get a smooth transition. You can't smooth the transition without data availability to enable people to make decisions based on that data, right? That was what was driving the data availability, to drive decisions. We also now have more and more investors, and I'm going to go all the way down to the individual, more and more investors looking for ways to express their preferences for a different kind of world. They can't express their preferences if they don't understand where their money is going and what their money is doing. That means we need more disclosure. The financial institutions can't fully disclose what they're exposed to or causing, and I would use both, without better disclosure from corporates. We also need to get asset level disclosure, because once you're talking about the physical risks, you really need to know where your assets are located. If you look at water risks in particular, that's entirely geographical. We've got some great tools for looking at water risks, but there needs to be a lot more. We also need to move beyond just looking at the climate risk to looking at nature risks. And this is the part where I get to use new acronyms. So IPBES, the Intergovernmental Platform on Biodiversity and Ecosystem Services, issued a global assessment report on Monday. Top line, about 1 million species are at risk of extinction, some in the next decade, 25%. So you don't have to like elephants, we do, but what you have to understand is the interaction between plants and animals and climate and human health. So about 60% of our CO2 emissions are absorbed by marine and terrestrial resources. Healthy soil absorbs more carbon than degraded soil. A biodiverse forest absorbs more carbon than a plantation forest. If you want to make your modeling super complex, look at what happens when you get 1 million species going extinct. We're basically looking at the 6th mass extinction starting now. This has complex and important interactions with climate and the SDGs, so one of the Sustainable Development Goals. One of the components of the IPBES report was to examine how nature was related to the Sustainable Development Goals. And about 80%, they found about 80% of the targets are impacted by nature loss. The hunger-related, the poverty-related, the climate-related, water, land, health. We're not going to meet the SDGs either if we lose nature, and we won't meet the Paris Climate Agreement if we lose nature. So this modeling has to take into account all of it. And regardless of how complex it gets, you have to remember the 2 billion people. Pull back up, use the numbers, and then pull back up to the why.
Okay, thank you. So. Thank you, Margaret. This is extremely inspiring. Wilhelmine, if I can come to you. I mean, this is a complex issue, and we're trying to translate that image of having to take account of nature, SDGs, and actual objectives, outcomes, and try to translate that into a language that finance institutions can speak, right? And the TCFD innovation is say, well, we're going to do forward-looking scenario-based analysis, and we're going to translate that into risk and opportunities. And so, as we are on that track, Wilhelmine, it would be useful if you could take us through the actual opportunity that scenario-based analysis brings, as it brings the climate perspective into the decision-making, into portfolio management, into company engagement, and how you think scenario-based analysis might evolve in order to respond to not just assessing risks and disclose, but meet the broader climate and sustainability agenda, as in aligning portfolios with this agenda, in addition to thinking about risks from a financial perspective. That is a broad question, yes, but I think you can do that.
I'm gonna run with it.
Thank you.
Thank you, Elodie. Thank you also so much for all the organizers of the event today, UNEP FI, Carbon Delta, Vivid, for having me here. I feel humbled to be able to contribute and thankful for being part of the discussion. So, Ortec Finance, never heard of us, I'm sure, but it's actually a company that's been around a long time, specializes in technology and solutions for risk and return management. And it's actually quite exciting that you have never heard of them, because they are really not active in the space of climate or thinking about economic or financial development in a holistic way. They are specialized in designing state-of-the-art scenarios which global investors, especially asset owners around the world, use for strategic asset allocation and asset liability modeling. So I always find incredibly encouraging if these type of normal financial risk modelers are starting to take this problem sufficiently seriously to start to hire people like me. Because I didn't think that I would ever end up working for this kind of a company. But here I am. And I came in dazed and confused, because I was like, my gosh, asset owners, the fat cats, if I may say so, that sit on top of this whole financial ecosystem, if I may dumb it down a little bit, but they take one really important decision, that is strategic asset allocation. They decide what gets invested in what at the highest level, and they have the power, respectfully so, to tell the asset managers what to do with their money. And I was shocked that the modeling, the quantified modeling that they use to make these super important decisions, just simply do not take, to begin with, climate change, let alone all the very important topics you just mentioned, into account. And I was absolutely shocked. So that was the challenge that was set for our team to fix that, or at least to start fixing that. I'm not going to say we have fixed it, but we have, a version to start thinking about it. And what we did is we went to the climate scientists, scientific community, people like Cicero, people like the Potsdam Institute, looked at the climate science, then talked to a range of some of the best macroeconomic modelers with their integrated assessment models, which we've learned about. Say, okay, how can we change these macroeconomic models to incorporate the climate science data? And how can we get inputs from these macroeconomic models that take trade dynamics into account, that take the effect of what we call systemic climate risk into account? I'm just going to talk a little bit about that, because the excellent work of parties like Carbon Delta that really understand the company level risk. If you're a universal owner and highly diversified, to a certain extent, those company level risks net out. And what you have left is a residual risk. And those residual risks are systemic, and they are in every single global pathway scenario they are there, be they be the transition risk remainder or the physical risk remainder. And if you're highly diversified, then that is the part you're not going to be able to diversify away from your portfolio no matter how hard you try. And we try to really capture that element, the interactions between companies, the interactions between trade flow. What happens if suddenly a company can no longer benefit from exporting fossil fuels? What does that do to government expenditure, and how does that circulate into the system? Also looking at the physical side, if agriculture productivity collapses, what does that do to the macroeconomic system? Those kinds of questions we capture through the macroeconomic modeling. We have a partnership with Cambridge Econometrics who helps us with that. And we get a different type of GDP development, because a lot of this financial modeling depends on GDP, interest rate, inflation, continuing as it has historically. Those models are based on historical figures, but obviously it's not going to be that way in a world of quick transition or in slow transition. So we are pretty much doing stochastic, forward-looking financial modeling using adjusted macroeconomic inputs to inform how asset classes will behave differently under different global warming assumptions. And I think that is important to understand. We model out to 2100, which might also be shocking to the financial sector in the room, but we think it's important to show you what happens to your portfolio in a 4 degrees world. It is not a pretty picture. Coverage ratios disseminate. So, and I think that's another powerful tool that we have kind of managed to take the climate science and put it in a language that is natural to the financial sector, that is not a parallel process, that expresses these risks into core risk metrics that you're all used to using, that are the normal language at the board level. So I think that's very powerful. You can put it in software, it can be efficient. So I think that will really help take it further. And I also think that that's somewhere where the next step lies, to look at the macro modeling and also to look at the micro modeling, because you need both. I'm not saying it's an either or story, but to consistently combine them, and we're very excited to thinking about that with, for example, Carbon Delta and others in the room to do that. But really understanding these systemic risks, which are many-fold of just the micro company sector risks because of all these complex interactions. How to get really concrete action? Bravery.
I mean, of course, but not necessarily. I mean, what sort of process are you thinking of in terms of having these elements integrated into portfolio allocation and decision-making processes?
Yes.
You know, what is the thought process that we would have to think of?
The thought process is really to understand that you cannot diversify your way out of this risk. You can do things at the strategic asset allocation level to try and mitigate that risk, but because they are systemic, the only way you're really going to manage those risks is to really bring your contribution to decarbonizing, And that does mean switching to, for example, other benchmarks, giving other mandates to your asset managers to be a little less hung up on things like tracking error, because I think we're too stuck in our traditional ways of thinking about that.
And so, out of curiosity, Sasha, would that add complexity to the current situation, or would that help simplify and bring in the macro perspective directly into the decision-making process?
Everything that simplifies our ability to make money is good. But the thing is, and I'm honest with this, because some of these projections, I mean, even the model that has been used earlier, I mean, the people in my line of business, they think about how can I make money out of this year? I mean, we are sort of too far away, and you think that these people will take on the bets that will happen 2030 as if they care what's going to happen 2040 or 2050 or 2100 or whatever. I mean, the problem we have is that we need to get this to work for the short term. And that's sort of however we make it. I mean, if we have a macro sort of a type of slash in a way of how we get the information in or how we can price in things. I mean, I've been in this business for a long time, and it feels like we are, the more we talk about the long term, the more we continue doing exactly what we've been doing last 45 years. Because it's too far away, we have difficulties to grasp it. These people are not incentivized to do anything that is 2020.
Quickly comment, because our modeling actually shows that an orderly transition, even to 1.5 degrees, gives you, what is it? I have the figure here. 6 percentage points better performance than if you wouldn't do anything. So business as usual scenario. So on the short term, it's not only economically beneficial, which is one thing, but it is financially beneficial. So really, there is, to me, no excuse. And it also solves perhaps that intergenerational problem that we see with some people thinking it's going to cost me pension now. Actually, no, it's going to lead to concrete, financial additional returns in the short run if managed correctly in an orderly fashion, and you're going to mitigate some of these horrific risks that we've been talking about in the long term. So, frankly, what are we waiting for?
Yeah, I just think you should just, book yourself through entire Europe, all the asset owners. We can go together and let's have a chat. Yeah.
Sounds good.
Okay, thank you. That's business in the making. Steve, so you didn't make the acronym, but you did contribute to produce the recommendations. And so, what is your perspective in terms of what has happened over the past 2 years? What do you think should happen next from a TCFD perspective, but also bringing that broader view of, disclosure contributing to the climate objective, or what else?
Thank you, Elodie. Before I answer that, and I will answer that, I want to just commend and back up what everyone else has said. Commend UNEP, and you particularly, Remco, Jennifer, everybody at UNEP for the work that you've done to make this report happen. And I don't know how many of you know in the audience, but someone at UNEP managed to get this report to be the lead news item for 3 hours last night on Sky News. They claim to have had 169 million viewers.
Sally,
how many of you saw that?
Hi, Sally. She's there.
Okay, two saw. Sky News. That's awesome. So well done, you guys. And I should also commend Ben Carr here, who led the expert group at Aviva, 29 people all working on the work. So, okay, well, thank you. I shouldn't have done that. Well done, Ben. Now, there have been some really scary numbers here today. The 1,400 trillion figure, that was, for me, the one that stood out a long way. It's 5 times the stock of the assets that I knew existed in the world. So quite how we're getting to that figure. We've got a lot of growth before we can lose that amount of money. But it is nevertheless a profound issue that we all need to start to manage. I thought the very aptly named Professor Hope made a very good point when he proposed that we have the financially neutral carbon tax. And he's the first person I've seen put $310 on the price. Now, if that's what we need, that's what we need. And what I think we all need to recognise, and just to amplify what the Bank of England was saying, you can't divest your way out of climate change. And just to kind of come back to the conversation that we've just been having, strategic asset allocation isn't going to reduce the fact that civilization is at risk. And you can't manage climate risk by just moving between asset classes. Perhaps the asset class that is least risk, at least from a transition perspective, is infrastructure. But from a physical risk perspective, you've still got it too. So I actually think from an investment perspective, whether it's transition risk and the value at risk figure that we've seen here today, the Barclays work that calibrates the amount of revenues that would be lost from the fossil fuel sector at 34 trillion. That's the kind of transition risk side of things. Or then you've got the physical risk side, the other end of the bar curve, if you like, if we don't deal with climate change. The study that we helped with in 2015 from the Economist Intelligence Unit, that calibrated the value at risk there at $43 trillion. So it's expensive. It's expensive unless we do the managed transition. So the best mitigation strategy for any investor, be they an asset owner, an asset manager, or an individual investor, the best mitigation strategy is to get the people who are supposed to correct the market failure to correct the market failure. So the other really scary figure I heard today was that even the nationally determined contributions underpinning the Paris Agreement, which the best efforts of every country put forward, get us to 3.4 degrees. That's nowhere near Paris. That's nowhere near Paris. That is much closer to chaos. We've said at 4 degrees, we think it's an existential challenge for our sector at 4 degrees. If you think about it physically, the Alps look like the Atlas Mountains at 4 degrees. Those of us that like skiing, you're not going to the Alps to ski. Siberia is valuable real estate because that's where humanity has to move to. Northern Alaska, equally, that's where. So these are huge, huge changes that we're talking about. And one of the problems I have when we start to engage with this, and it's important that we do, when we intellectually start analysing this issue, you can start to emotionally forget what it actually means and lose that Greta Thunberg type passion for how do we then mobilise that change. So if it is the world's biggest market failure, and it remains today the world's biggest market failure, despite Paris, because it is an ambition, not a reality, how do we collectively make Paris a reality? And unfortunately, Elodie, that's where the UN and you and your colleagues come back in again, because when I look at the nationally determined contributions, they don't include a carbon price that any of them, they don't include a carbon price that's anywhere near where it needs to be. Even the ETS, the European Emission Trading Scheme, today it's trading at 21 euros. That's great if you look at the last 10 years. It's not great if you look at the last 20. It's been up and down all over the place. So it needs to be at least 10 times bigger. We've heard that today, but where is that within the EU NDC? Secondly, not only do we need that cost of capital to be reflecting the cost of carbon, but we also need financial regulation to be massively updated. On the FSB TCFD, I speak for myself when I say that it needs to be mandatory. It's voluntary, but it needs to be mandatory. And though even when it is, it's nowhere near enough. And it isn't even beginning to manage or drive down prudential risk, even if it's mandatory. Because it's only measuring the temperature, if you like. If you know the metaphor of the boiling frog, that as you turn up the heat, the frog doesn't know and it doesn't jump out. So the way I like to think about this is the way we're fueling our economic growth is fueling the fire underneath the saucepan with the frog in it. The markets are the water, that the temperature is changing rapidly. The planet is the frog. And the insurance and investment sector, we're the thermometer. We're the ones saying, listen, there's a problem here, particularly insurers who are the canaries in the coal mine when it comes to climate change. The TCFD just gives us a better thermometer. It doesn't change the temperature in the water at all. For that, we need the cost of capital and the cost of carbon to reflect that. We also need to change prudential regulation. For those of you that don't work in banks or insurers, prudential regulation, Basel III if you're a bank, Solvency II if you're an insurer, that weights the capital that we have to keep on our books when we take different kinds of investments. it makes sovereign debt much, much cheaper than infrastructure. It makes corporate debt much, much cheaper than a renewable energy investment directly owned. Now, the unintended consequence of that is that we are penalized for investing in infrastructure, which, by the way, 80 to 90% of our run rate there is renewable energy or energy efficiency technology. We're penalized from owning that, and we're encouraged to own corporate bonds, which is the old economy. The most significant sectors in corporate bonds: autos, banks, fossil fuel, chem, and telco. Those are what we're financing with insurance money. That is insane. Insurers are at the front line of this problem, and yet that's what supposedly prudential regulation encourages to do. Why? Because it's written through the rearview mirror of the credit crunch and the financial stress before it, not through the coming climate crunch that we can all see through that windscreen. So we need to change financial regulation. We need to get cost of carbon reflecting this a carbon price. And we also need to recognize that if the IEA, the International Energy Agency, says we need $1 trillion a year to finance this transition, that trillion could come from us. It's about $5 trillion in this room. Now, what we miss, if you were a company's chief finance officer, you'd have a capital raising plan. You'd know whether you were going to go to the markets for equity or debt and when. What we don't have is a capital raising plan for the planet. We have no way of knowing now how we're going to get that $1 trillion. The UN should work with the World Bank to produce that.
Absolutely, Steve. Steve, would it be too bold to ask you to comment? I mean, prudential regulation has to change. Financial regulators have to come on board. I think from a UNEP FI perspective, we are exploring indeed different types of avenues. We heard a fairly positive speech from the Bank of England earlier today.
Remarkable.
Exactly. So on a scale of 1 to 10, you know, where the green supporting factor might be something missing on the list, but where would you range progress on financial regulation has been happening the past year? And you know, how much do you think we should push for this to accelerate, if you think this is where we're going to drive money and capital from?
So if Greta Thunberg was aware of what's been going on within the European Commission and their action plan, within the UN and your own strategy that Antonio Guterres set out last year, within the UK with its Green Finance Initiative, with the Financial Stability Board and its own work, and now with all these other central banks catching up, if Greta was aware of that, I think she would have more hope than she seems to have today. I've watched over the last 20 years, and I never, ever expected to hear the speech that we heard today from the Bank of England. It was remarkable for them to be as clear as that this is an issue. It was huge. But we've relied upon actually Mark Carney and his understanding of this issue, because the previous governor fought off any suggestion that climate risk was something they should be looking at. Mark's leaving in February. So what I think we need to do is start to massively change the way that these regulators are structured and make it clear that it is part of their mandate. So I have huge hope.
Okay.
If you look at what's been happening in this space, we're starting to get the top tables talk about this problem and take it seriously. And we have the money. The money exists to finance this transition. We just need to move it, and it doesn't move because people care. It moves because there's a risk or a return. We need to make that risk-return trade-off matter much more via that, what did he call it, a fiscally neutral way of working a subsidy and a tax.
Thank you, Steve. I think I'd like to take a few questions from the floor, if there are. Do we have the ball? The yellow, yes, but it's quite far there, so you might have to do a few different, like a few passes.
Former rugby player.
Don't worry, it's only 500 quid. You're welcome.
Thank you so much. Actually, it's a question for you.
Oh.
Okay.
If I may.
Okay.
Knowing the scale of investment that we require, basically knowing the urgency of the investment that we require only in infrastructure finance that you mentioned, how do you encourage your organization now to scale sustainable finance and financing, and what other encouragement you already hear about Bank of England and regulation and stuff? What other sort of encouragement would you recommend?
Mm-hmm. Can I take just another question, please? From behind you, actually, Madame, just if you can pass the board to... Voilà. Thank you.
Matthew Carr from Bloomberg News. The panel focused a lot on the scary stuff, but $300 a tonne of carbon dioxide brings a whole plethora of new opportunities.
Thank you. Thank you.
Why is it that you guys aren't speaking a lot about how much money you can make out of carbon capture, out of power when carbon is that high, out of biofuels, out of all of the other exciting technology that will be financed by such high carbon prices? Isn't that what you should be talking about?
Mm-hmm. Thank you. One last question and then, well, yes, please.
Hi, can you hear me? Peter Cripps from Environmental Finance magazine. We've heard that the TCFD needs to become mandatory, but will that really do any good if there isn't more control over what people report? I think at the moment I'm right in saying that the majority of TCFD reports have found that even in a 2-degree scenario, these companies are doing very well for themselves. You can call it technological optimism. I've heard other people say, put bullshit in, get bullshit out. But whatever way, some people assume that there'll be CCS in the future and their industry will be fine, or whatever their sector will assume, will be all right. Do we need to be more stringent in terms of what we're asking people to report if this does become mandatory?
Okay. Thank you very much. Sasha, would you like to kick us off with how do you encourage your organization to take action on the different... Oh, it was on Steve. Pardon, Steve. Sorry. Go ahead.
So, do you want me to answer all three quickly, or first one?
I mean, yeah, of course. If you want to take a go at.
So, for our own assets, there is a report that we did at the end of last year, which is on our website. It's a stock take of our own climate change strategy. The quickest way I can answer that is to give you that report, which I'll do afterwards. In it, you'll find that we've been investing over £500 million a year in green infrastructure. We've got approaching $2 billion in green bonds. Now that's good, but we run $350 billion. So how do we close the gap? So the way we close the gap is by making the market is amoral. The market is amoral. You need to make the risk-return trade-off pay so that it's not someone's conscience, but that it's actually capitalism working as it should. Markets have failed. The way they're corrected is by people like Mark Carney doing what he's doing, and by governments doing a lot more than they are to change the incentive structure. That's one. Two, Peter Cripps' question, good question. So it should be mandatory, even if it is, it won't be enough. I mentioned earlier that solvency regulation needs to be updated. I've heard of GIGO, garbage in, garbage out, but not BIBO before, so that's a good one. I don't think that we're going to manage this issue just by looking at the temperature. We need to turn down the heat, and that means moving money away from the fossil fuel sector and into renewable power generation. So that the TCFD only informs that debate. It doesn't drive it. It doesn't force it. And then the opportunity side from Bloomberg, I refer you to Bloomberg New Energy Finance for a whole raft of opportunities for you to put your money in.
Margaret, do you want to jump in?
I especially want to come in on the fossil fuel point. So the IMF published a report last Friday looking at fossil fuels. And one of the things they found was there hasn't been a lot of progress in reducing fossil fuels despite the Paris Agreement, despite the G20 identifying fossil fuels as a problem. $1 trillion, where does the $1 trillion come from? 5.2 trillion in fossil fuel subsidies, 6.5% of global GDP. So this is not all about how do we get more money into the transitions, how do we get less money into the things that are pulling back the transition. Point one.
Sasha?
Yeah, I think it's the response to that. I think it was a guy from Bloomberg. Have you seen the list of how many companies Carbon Delta had on the list of the renewable energy? 18. The reason why $300 a carbon price is so scary for us, and we look at it from a risk side, because we look down and think, oh, we are sitting on a big problem right now. On the energy side, renewable energy side, and the opportunity side, of course, there's a lot of opportunities. But if you look at the numbers, 11% of the energy in the world today comes from renewable energy. The energy agency in the US and all the different calculations that we've been looking at is basically suggesting that 2060 we will have 55% of the energy production in the world coming from the fossil fuels. That's the fact. So the reason why we sort of see it from a scary side is that all of us are thinking, well, if it's gonna cost this much, then we need to de-risk what we have. And one of the ways of doing it is to actually try to find ways how to reallocate capital somewhere else. But bear in mind another thing, 83% of the capital in the world, all the money in the world today, does not take into account anything on climate. So we are talking still that, I mean, we've done huge sort of improvements over the years, but we have still huge amounts of money. If we just reallocate them in a smart way, we can use the financial toolbox much more efficiently than we are using it today. But these are the sort. But I think that the thing with the Mark Carney and the tragedy of Horizon is actually one of the biggest challenges this industry. And we in our own industry, we don't want to talk about that. You think we're long term? Yeah? No, we're not. We're very short term. If you are portfolio managers, you don't perform in 1 year or two, you're out. And these are the things that we don't sort of see it from the industry point of view. Of course, we are aware of the fact, but we need to sort of change the underlying incentives for this, and regulation is one of them. Mm-hmm. The being mandatory, the reporting is one of them. But industry in itself, we are not sort of structured for this.
Mm-hmm. Yeah.
Opportunities. A word that's been kicked around a little bit in the Netherlands recently is the word Marshall Plan. And it's interesting because honestly, what is needed is a huge amount of creative destruction and rebuild. And there's winners and losers. And those are probably the write-offs that we're quite scared about, of infrastructure or other business practices that simply don't fit under a certain carbon budget and needs to be replaced. And that's where the opportunities come in. And the good news is that the net effect, if done and managed well, is likely to be positive. So yes, there are vast opportunities, but there is a big scary part that needs to be managed. And because essentially that is, if you consider we have to probably retool most of our infrastructure within a 10 to 15-year horizon, because that's what we're talking about, that is unprecedented coordinated action across finance, across government, across industry, and it needs to be coordinated. And it is an opportunity. It's also scary, yes. Maybe that's why I do believe also in the modeling and integrating it into this kind of strategic decision making, because I think financial decision makers, like asset owners, need to understand why they should be doing something so drastic. It needs to be plugged in at the top level of decision making so that there is an appropriate framework for those extremely radical decision making to be kind of acceptable as you go down the supply chain. You need that. Why are we doing this? Kind of integrated in the financial modeling at the strategic level itself. Maybe one more word about the reporting, about understanding assumptions perhaps, because I think instead of thinking about how is disclosure consistent, it is very important for people to start to educate themselves around these scenarios and the kind of assumptions that go in them, because they vary widely. And there is a lot of ones that are much more ambitious and others that do have some fairy dust sprinkling of imaginary CCS rollout in there. Being respectful here. Yeah, so I'm trying to be. But yeah, I think it's very important to understand those assumptions, and it would be extremely helpful if people are educated about those assumptions and we can have an honest discussion of what are reasonable assumptions within the extremely tight carbon budgets that we have. What I hear a lot is people say, yeah, but you know, that carbon budget is not realistic. We're never going to get there. It's like, yes, but then you're not modeling a 1.5 degree or 2 degree scenario. You know, you got to pick. So I think really understanding the assumptions, us as service providers and people active in the industry, to enable decision makers to understand what those assumptions do in the modeling, to enable them to understand sensitivity. So I really don't think there is one scenario. I think it's really about understanding what drives those scenarios and enabling decision makers to understand those sensitivities and make decisions for themselves.
Thank you very much, Ilimin. This can be a tough exercise, except for those that are used to that, but I'd like, because we're going to have to close this panel, so if you could make one line, one statement that describes what you think should happen next, then I would like to have something positive, something actionable, soon. Is that, who wants to start? 1, 2 sentences, really not more.
I can start.
Please, Sasha.
So for Nordea, we're going to feed the report and the findings of the report to every PM we can actually find internally.
Do you have PMs?
And we have internal, we're going to feed them with information. We're going to educate them and we're going to work with them with that. But that's the internal one.
Thank you.
And for the external one, I don't know. I mean, it's I think what I said initially, we need to work with corporates much more, with investee companies. And I think next session will be to sit down and have these type of discussions with companies and their sort of plans to mitigate and adopt to what they need to adopt to. And I want to add one more thing, which I think Greta, and she's Swedish as well, sort of bringing up to the world, saying that, you know, there are not so many in the city here or in financial centers in the world, there are not so many bankers having anxiety about the climate. Because they think they're on the safe side. They got the money. They can buy themselves out. So these are the things, we're not thinking about social climatic path of this, where this goes. And I think that's one of the angles that we are not sort of thinking. We are not so safe as we think we are from that angle. But that's more sort of from a risk perspective. Yeah.
Thank you. Margaret, would you like to go next?
Yes. I want to say thanks again to UNEP FI and to Aviva and all of the investors who played a part in the analysis, because I think this is extremely important work. We need more of it. It needs to go faster. Disclosure needs to be public. Everyone's always asking, what can I as an individual do? Just curious, go find out where your pension is invested. There's your homework for the weekend. Go ask.
And reading the report as well for the weekend.
Just 120 pages.
120 pages.
Nothing.
Brought from us to you. Steve, please.
Thank you, Elodie. We've heard the Marshall Plan mentioned. The Marshall Plan plus the entire Apollo program times 4 is what we need each year. Okay? That point I made earlier about needing a capital raising plan to mobilize capital at that scale, very happy to help produce it, but it needs a multilateral effort with capitalists meeting multilateralists at G20, G7, UNGA. That's what you need to do.
Thank you, Steve. Ilimin?
So our ambition of my team is we're starting with climate change, which is great, and really integrate that into financial decision making at the highest level. But if you ask where we'd like to be in 5 years, is that we have an integrated strategic risk management system that's about water scarcity, about biodiversity, about social inclusivity, about I'm a big fan of the donut economy, and I guess I really hope to be building together with colleagues, together with clients, together with collaborators, actual tooling that helps to implement that idea to really move our economy to a completely different circular system instead of the linear dead-end track that we're currently stuck on.
Thank you, Elamin. Can I ask everyone to join me in thanking the panelists, please? Thank you very much for your insights. Those were inspiring, valuable insights. I will, without further ado, introduce Ed Baker from the PRI, who's the Senior Policy Advisor at the PRI, I just said it, to close this session. And thank you very much.
Thank you so much.
Thanks.
Yeah. Well, thanks very much, Elodie, and thank you to Aviva, UNEP FI, and all the participants today. I'm humbled on behalf of our CEO, who unfortunately can't be here to give these remarks. I was sort of struck by a point that I think was made earlier about TCFD being easy to like but hard to do. So I hope as a result of today and all of the effort that's gone into this initiative that it's become easier to do and even easier to like. I thought it was particularly outstanding, the quality of the report that's been produced, the tool, the participation by investors, and that last panel discussion. What great insights and just a frank conversation. So if you could all give a round of applause for today's event, please. TCFD came up a little bit. It's just how valuable as an exercise is this really? And I think that's a good question to ask. I think it's more, though, than just a disclosure framework, because once you have to disclose something, you actually have to do something at the same time. So it is a forcing mechanism. And in terms of thinking about all actions we can take forward, I'd just like to share how PRI is planning to contribute to your efforts. So PRI, as a signatory PRI, there is a requirement to report to us on an annual basis. And we've introduced climate-based indicators which are based on the TCFD. And so these are currently voluntary, but we have announced that they will become mandatory from March of 2020. So globally at the moment, we're receiving about 600 investors, 100 from the UK that are reporting to us. However, from next year, this will be stepping up to 2,000 in 60 markets. So we hope that's a sign that take all the great work that you've all been part of today and really to give it sort of critical scale in the near term. So thanks again for the opportunity to speak at your events, and I wish you all a good afternoon.
I love being the last speaker before drinks, so I'm going to indulge and make this as long as possible. No, I want to wrap up and let you go to the reception as quickly as possible. I want to thank everyone. I want to thank again the 20 investors. I want to thank Aviva for hosting us today. And I'm going to, I'd like to, call the investors to action really, I think, on 3 fronts that also provide to a certain extent a summary of what we've heard today. Firstly, with this guidance, if you're an investor, you can start making progress on TCFD. You can start making progress quickly on climate-related assessments and on disclosing the results of those assessments. So go ahead and do that. But I do agree at the same time that if you take a step back and you look at the planetary dimensions here, TCFD might seem a little bit as mental acrobatics. We're doing something to keep busy, while the real solutions are in front of us. And Steve spoke about the number one real solution that we need, which is a high enough, and Chris did so too in the morning, which is a high enough carbon price that manages to internalize this carbon externality that is creating the market failure. And so one call to action would be, can investors flex a lobbying muscle or develop a lobbying muscle that can actually compete with the lobbying muscle of the fossilist economy? Because at the moment, in the political economy of climate change, you have a fight between the fossilist economy and the renewable economy, the renewable energy technology economy. The finance sector, including institutional investors, have been there, but not to the extent and effect as the other side. So please do that. If you want a carbon price, let's do a global lobbying exercise by all asset owners around the world to make carbon price a reality. And the third thing that I think you can do is, you will need, once there's a carbon price and once you've done TCFD, you will have to be looking at the companies in your portfolios, and you will have to be looking at the data about those companies. How carbon intensive are they? Are they on a path towards Paris compatibility or not? And very often, or the call to action is that you do not wait for the disclosures from those companies, because those disclosures will be slow, if they come at all, and those disclosures will probably be not the most objective disclosures as to where each of those companies stand. And you don't have to wait for those company disclosures necessarily, because increasingly, all of that corporate data, including at the asset level, is available in databases. There's a whole effort around asset level data that is being built that is trying to address precisely this asymmetric information between investors and companies. So investors will increasingly be able to just tap into that data so that they can engage with companies at the same level with no information asymmetry in between. And with those three calls to action, the fourth one would be go and help yourself with a drink. Thank you.